Smith alongside Brad Smith, and we are just moments away from December payrolls here, estimated to come in at 165,000. This is for January, not December. When you take a look at that number here, what we are expecting, 175,000, that's expected to be the headline number here. Average hourly earnings on a month-over-month basis, that is expected to rise 0.3% on a year-over-year basis, or rise at 3.8%. That would be a slight slowdown from what we saw in the prior reading of 3.9%. But that unemployment rate is once again going to be a focus here. It's expected to come in right at 4.1%, which is in line with what we saw last month here. But Brad, once you square that with the revisions that we are expected to get, the wildfires out in California, the cold weather in so many parts of the U.S., this is set up to be a more complicated report than maybe most.
Yeah, and even as we were getting some of the labor market data earlier this week, ADP private payrolls, JOLTS, of course, we had spoken with Naila Richardson, who's the chief economist over at ADP, and she joined us and gave kind of a precursor to some extent, at least on the sector front, because she envisions that this could be continuing to be a challenge for the Federal Reserve, especially as it comes to the labor cost side of this print that we could see come forward today here. And so saying that it could be a challenge for the Federal Reserve because labor costs aren't going down. They're staying stuck at higher levels, translates to sticky inflation there. So this, of course, one of the two mandates that the Fed has that we're going to get a little bit more of the insight on, of course, here today with this jobs report. And you were mentioning specifically on what we're expecting with that headline print, but ultimately, as I'm looking through some of the hourly earnings expectations here, we're looking for about the month over month to come in at 0.3% average hourly earnings year over year for 3.8%. We are just seconds away from the January jobs report, and that January payrolls report crossing the wire right now. 143,000 jobs added during the month of January. That is below the estimate here. You're also taking a look at the change in average hourly earnings month over month. That came in at 0.5%, and then year over year that came in at 4.1%. And the unemployment rate, that actually came in at 4% versus the 4.1% expected. You're seeing some reaction here in the futures. We are lower fractionally as it may be across the board right now, Shauna.
Yeah, exactly. So as we do take a look at the futures reaction here, we are looking at some losses here as we do wait a second here to react to this jobs print. So much lower than what the street was looking for. Again, the forecast was for 175,000. We are seeing 143,000. A big question is whether or not this would be weak enough for the Fed to change its tune or change the narrative. Very much we're going to put that question to a number of guests here this morning. But again, this disappointing jobs gain, but the jobless rate, though, is lower. So when you take a look at the unemployment rate also coming in slightly below expectations at 4%. Once you dig into the sector action, we get a better picture of what is going on here. But again, we are seeing some selling across the board for the major averages, although it is important to point out that we're not really seeing material sign. We're actually moving off the lows here of the morning as I'm speaking right now. But again, as the investors do take some time to ingest all this and digest this, will be interesting to see just how this changes, if at all it changes the calculus, just in terms of the strength of the economy.
You mentioned those sectors. I'm taking a brief look at where job gains occurred. It actually was in healthcare, retail trade, and social assistance. On the other side, you saw employment decline in the mining, the quarrying, and oil and gas extraction industry. So we'll dig further into those sectors just a little bit later on. We've got our full newsroom covering this as well.
We certainly do. And I also just want to take note the revision that we got for the month of December. That was revised up to 307,000. Remember, the initial reading was 256,000. That was revised up to 307,000. So maybe offsetting any of the weakness that we're seeing here in this most recent report. All right, let's bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. We also want to bring in Noel Coram, senior portfolio manager at Agile. It's great to have both of you. Steve, just your quick reaction to this report and whether or not maybe this does change the calculus at all.
Well, Shauna, I'm not sure it does in a major way because, yes, the headline number was lower. My first reaction was, that's not good. That doesn't jive with what we heard from ADP, which is a very imperfect indicator anyway. Mm-hmm. But then when you, as you mentioned, with the revisions being much higher than we thought, and then we have the unemployment rate going down. And to me, the interesting one is the monthly gain in average hourly earnings at 0.5 as opposed to 0.3. That's telling us that people have jobs. Most of the people who have jobs, who want jobs, have them, and those who have jobs are getting paid more. And if you're talking about, again, the dual mandate of the Fed, which is stable prices and full employment, well, you've got your full employment, at 4% unemployment rate, and do you have your stable prices? Again, I want people to get paid. I mean, that we all should do that, and we all should root for a stronger economy as opposed to a more accommodative Fed. But that's what this number tells me. The Fed is not this doesn't incentivize the Fed to do anything right now.
Noel, want to get your initial read-in on the print?
Sure, I had the similar reaction as Steve, like, whoa. But if you actually look at the revision, we are looking for a trend around 200. That's right in line with what we would expect. The Fed's looking at the trend, we really don't think it changes the calculus, as you said, for the Fed and where they want to go this year.
Steve, how do you think, just taking a look at the market's reaction, if we could put the 3 board up just in terms of the major averages and some of the action that we're seeing here in pre-market, I think it very much aligns with the fact that we haven't seen too much movement here. We're right around where we were right before this was released and right after it was released here. What does that signal to you just in terms of what the market is looking for? And it looks like this report, given the revisions, is enough to keep that narrative intact.
Well, I think so, because there's this dichotomy of, do we want, yes, in the perfect world, some of what we got last year was an accommodative Fed and a strong economy. I think they're moving away from that notion of giving us both. So again, I think if we have to choose, we should choose the stronger economy, which is why we see a fairly muted reaction in stocks. It's a little disappointing, from that point of view. But I'm watching bond yields right now, and looking at my screen, they're about 3 or 4 basis points higher. So taking the lead from the bonds, if the bonds aren't freaked out, well, then why should stocks be? Because this is probably a more bond unfriendly number than it is a stock unfriendly number.
Yeah, Noel, as we've been talking about this morning, the reaction for the markets relatively muted off of the back of this report, even if to the downside, just fractionally here, flat, barely to the downside. What is the initial trade that comes to mind for you off of a print like this, knowing how the Fed might ingest it?
For us, what we're focusing on this year is the 3 T's, so tariff, tax cuts, and term premium. How is policy going to play into those, and how's it going to feed down into the data, right? So far, especially in the first half of this year, we think growth's going to be solid. The Fed's going to be on hold for majority of the first half, potentially looking to renormalize later in the second quarter. And of course, inflation is going to be muted. So what does that mean for markets? It means that risk is actually going to do well here. And so we do like risky assets here. And then you can kind of pull in duration when you need to, if you see some of those tariffs, tax cuts, and term premium play out into the market.
Steve, should we at all be concerned about the average hourly earnings that you brought up there? The fact that that was much stronger than what forecasts had been predicting, and the inflationary pressure maybe that this could cause down the road.
This could cause inflationary pressures down the road, because again, higher wages do tend to lead to higher inflation. But again, that's probably a good kind of inflation, because right. The price of eggs and coffee going up is not a good cause of inflation. The fact that more people have more money to spend and feel better about it, especially if they can actually save some, but people don't always do that. But that's sort of a healthy way if you're going to start having a little bit of inflation.
To what degree then, or I guess what is the threshold for it not to be healthy?
When it's really exogenous. Again, so there's so many soft commodities that are seeing rallies for just strange reasons, or as Noel referred to, tariffs are inflationary too. At least you can argue whether it's a long-term or a short-term blip, but either way, they're not helpful for prices or consumption. You're spending more money on essentially taxes, and so those are more harmful, as opposed to just the economy's doing well, people are productive, they can afford to get paid more. That's a good thing.
Noel, is there a basket of companies or a trade that is more exposed to higher labor costs as passed through to the mindset of the consumer and could rattle consumer spending, so much so to the point where it also impacts those companies' outlooks?
So if we take a big step back and kind of think about where we are in this cycle, what names do we like here? We like names that are going to be cheaper relative to their peers, right? Because those are going to be the names that do well when growth is doing well, when inflation is somewhat contained. You were just talking about wages. We think that the trend there is still going to be a little bit higher than where we need to be, around 2 to 3%, but it's still not enough to really feed into inflation, at least in the near term, in a significant way. As we get into the later part of the year, though, of course, we have to start thinking about policy, have to start thinking about tariffs, tax cuts, how that feeds into inflation. But for now, we really like to be at kind of that sweet spot of value where you do see some spread pickup in particular names relative to their peers.
Steve, what's your top trade as you look at this?
Noel mentioned value, and I think that remains my top trade. I think we're seeing a lot of portfolio managers rotate into value. We're still seeing a lot of individuals and more active traders still trading momentum, and it's hard to break their sort of love of big tech. But I think we're seeing a lot of money move into more defensive sectors, things with a bit of dividend, things that might withstand some of the volatility, because I do think we're going to get into a more volatile environment. And as an options guy, that means there's plenty of opportunities. But from an investment point of view, I think it behooves most investors to think a little less volatile.
And so if leaning into value right now, what is the time horizon? Or I guess the better question is, what would actually move the thinking for investors off of the value trade later down the line?
They've been off that trade for like 5 years, Brad. So really, it's what would move people back. People love the growth stocks, and let's be clear, that's what's brought everybody to the dance. And it's hard to, you're not going to abandon them, but I'm just saying maybe look at some of the wallflowers now and then.
Yeah, we were taking a look at some of that data showing the amount of new market entrants since 2020, which, to your point, so many new market entrants because of that growth trade that has really been prioritized.
Noel, real quick, before we let you go, let's just take a look one more time at the bond market here and the reaction that we are seeing. You've got yields pushing back towards that 4 or 5 level. Where do we go from here?
So I think the bias, given where policy is going from here, given the things that we need to watch, the bias is for higher yields. So we do think it makes sense to pull in duration for now. We still like risk here, though. Let's make that clear. And we continue to like names that are cheaper relative to their peers.
Steve Sosnick, Noel Coram, thanks so much for taking the time today.
Thank you.
We'll have more. Absolutely. We'll have more jobs report coverage later in the morning with Chicago Fed President Austin Goolsbee right here at 10:30 a.m. Eastern Time. Let's send it over now to our own Jared Blickery for a look at the movers on the back of the January payrolls report. Hey, Jared.
Thank you, Brad. It is a bit risk off here, but not in a big way. Let's go to the Wi-Fi Interactive here. We'll start with the Dow futures, and we have not seen a big reaction to the upside or downside just yet. We've seen this small one to the downside, and now we're heading back up, as you can see now, but that's just a lot of chop that we're seeing, no definitive direction. We see a similar thing in the Nasdaq 100 futures. Those have now turned positive, at least since yesterday, and we've taken a look at the S&P 500 futures, very similar story to the Nasdaq, where those have just turned positive once again after taking a little bit of a dip. Also throw out there, a lot of times we get another zigzag after the market opens, so we might end up heading down again. What happens today by the close is the most important. And as Steve was talking about earlier, we're not seeing a lot of movement in the bond market either, which is where you might think that we'd see more of a risk-off flavor. We are seeing the bond futures down, which means yields are heading up. But here's the 2-year U.S. Treasury note futures. Those are only down just a bit, about 9 basis points. And here's a 10-year down about 0.25%. And we do see the yields heading higher as these are selling off, but not in a big way. Also not seeing a big reaction in gold. Gold has been hitting record highs most of the week here. We've seen some action in silver as well, but not this morning. Not even a little zigzag there for some of these futures that we're tracking. Bitcoin also pretty quiet. Now, Bitcoin has been pretty volatile in some of these other non-farm payroll reports that I've tracked over the last few months, as well as CPI, but we're just not seeing that much of a reaction today. Maybe it's just ho-hum for traders. Hard to say. Here finally is the euro, and just as a dollar proxy, we are seeing this do almost nothing since the report. So I'll just close here by showing the sector action in the pre-market. We have tech doing the best. That's up about 32 basis points. You can see it was up 27 yesterday, 0.25%. Number 2 slot is energy, which was down the most yesterday. And today, what's suffering the most is XLY. That is consumer discretionary, down about 0.5%. And that is an Amazon story right here. Guys?
Jared, thanks so much. Appreciate it. Coming up, everyone, we'll have more on the January payrolls report and a look at what sectors gained and lost the most jobs. That's next on Yahoo Finance.
The U.S. economy adding 143,000 jobs in January. Unemployment ticking down to 4%. Our very own Alexandra Canal joining us now. She's been digging through the numbers, going sector by sector.
Yes.
Ali, what stands out to you in this report?
So first of all, heading into this report, economists had warned us there was going to be a lot of noise. We had wildfires, we had snowstorms, residual seasonality, the revisions. But this is a solid report, and we saw a lot of gains concentrated in a few industries. Healthcare, retail being two of the top gainers. So let's start with healthcare. It has been the most resilient industry, I would say, over the past year, adding 44,000 jobs in January. Gains were in hospitals, nursing and residential care facilities, and home health care services. And then on the retail side, another industry that's really contributed to a lot of positive swings to the upside. 34,000 jobs added last month, concentrated in general merchandise retailers and furniture and home furnishings. So just another indication that the services side of the economy, it remains resilient. Now, we did did see some impact from colder weather in January for the construction side. Just 4,000 jobs added. That's a drop of 10,000 year over year, and is also down 9,000 month over month. Similar story there with leisure and hospitality. Economists have warned us that colder weather was going to affect that industry. We saw a loss of 3,000 jobs after we added 49,000 jobs the month before. So a bit of a tough comp there. And then manufacturing is one I wanted to call out because we saw 3,000 jobs added, so little change, but this does come after we saw a 12,000 job decline, and we saw positive ISM data earlier this week saying that the manufacturing sector is expanding for the first time in more than 2 years. Perhaps that manufacturing recession could be over, and that could be positive for stocks moving forward. So another sector that I'm keeping my eye on.
Yeah, it was really interesting looking through some of these sectors, especially when we were thinking about how we can kind of compare, contrast this to what we had seen within the ADP private payrolls print earlier this week as well. And one of the areas that we were keeping a close eye on there was manufacturing sector. Here, the biggest declines seemed like they were in mining, quarrying, and oil and gas and extraction industry. Not sure why that's a tongue twister this morning here. I guess as we should think about some of the services portion of these prints, what are you kind of taking away from how that is all playing out right now?
Yeah, look, I think the consumer is remaining resilient. The economy is resilient. We have wages rising more than forecast, and it's a strong start to 2025. So the services side of the equation, I think, has been holding up really well. So that's a bullish sign. I feel like for stocks, the economy at large, you mentioned the ADP report, the private payrolls, but if we take a look at the government side, adding 32,000 jobs last month, pretty consistent from recent reports. However, looking ahead, it's going to be interesting to track this side of the equation, considering we have DOGE. What's that going to mean? The Department of Government Efficiency. What is Elon Musk going to do? How are the layoffs? How are those buyouts going to affect things? BNP was out with a note saying that it is too early for the DOGE impact to have affected the January report, but it's something to watch moving forward. They said that the buyout suggests net downward pressure on federal employment over time. So a lot to look at in this report, but I think the big takeaway is that the economy, it's pretty strong.
Yeah.
All right, Allie, thanks so much. Let's dig into this report a little bit more. Again, while January began with a weaker than expected 143,000 jobs added, the headline number, data revisions confirmed that hiring was strong at the end of 2024. The number of new jobs created in December was revised to the upside there from a previous 256,000. And November's employment increase was also lifted to 261,000, up from 212,000. Here to continue our coverage of that jobs report, we want to bring in Joe Bruce-Willis. He's RSM's chief economist. And Joe, it's great to have you here on set. There's a lot to unpack in this report, but you brought up something in the break that I thought was very interesting here, and that's the household survey, just in terms of what we are seeing there. Talk to us, walk us through the significance of this and what this signals, what this tells us about where we are.
For the entire year of 2024, the haters just attacked every month that we saw job gains because it just couldn't be true. Look at the household survey. It's not moving. There's a divergence. Well, the population adjustment made by the BLS corrected that, guess what, in favor of the establishment. There was an additional 2.194 million people working last year, according to the household. A lot of that does have to do with immigration. But what that means is we got a bigger labor force. That's a good thing. You know why? It means we got a greater pool of labor to draw upon. That means there's going to be less wage pressure. As you unpack this, what you're going to see is people are going to start making a reassessment of that September rate cut by the Fed, the one that everybody, craps on. No, actually, that looks pretty good in retrospect right now, is we got disinflation moving through the economy via the wage channel. Even with that 4.1% increase year over year today, this is aligned with what we're seeing in the employment cost index, which is the metric the Fed uses to make policy anyways. So, I like what I see in that revision. Now, on the establishment side, it was much smaller than what we had thought, was 589, right? What that means is instead of increasing at 186,000 per month last year, we increased at 166,000, just a moderately slower pace. So this really does look good. And by the way, the January jobs report, once you took into account the December revisions, total change in employment was 194. Our forecast was 185. 2 months, you got an additional 100. hey guys, this is a nice, solid demand for labor. I mean, there's really nothing not to like here.
So with that in mind, and the Fed's evaluation, because it wasn't expected that there would be any major decision coming off of this print particularly, but what are they going to be looking for, especially as the economy ingests policy decision making from the White House, from Congress, going forward from this juncture?
Two things, two levels. First level, first thing is we need to see rents ease. Second, service inflation is just stubborn and sticky. That's the thing you worry about if you're a central banker. And they outlined that when it was very clear that we were having a pandemic-induced price shock because we shut down the supply chains. Sure enough, it's manifested itself. Okay, the second level, it's trade and it's immigration. Now, my sense here is that the administration wants to provide a pretty big tax cut. I mean, when you add everything up, it looks like it's over $6 trillion over 10 years, right? They're going to need some offsets. They're going to, it looks to me, move to either ask for a border adjustment tax, which they asked for in 2017, which is perfectly legal under existing international treaties. Lots of countries have it. We just don't. Okay. If they can't get the votes for that, then I would expect they're going to impose a universal tariff somewhere between 10 and 15%. They need those revenues to be scored properly so they can get their tax cut. It's a movement in two parts. Second portion, immigration. Now, that's a much bigger deal. We need to think this through, because putting additional constraints on the labor supply, which we know growth is slowing, and by 2033 we'll move in the negative terrain. We got to talk about this, because that could cause some issues.
What could that look like?
All right, well, right now they're starting to deport people, mostly who've committed crimes. Okay, that's fine. All administrations do that. I don't see that being a big deal. If we get the first use of reconciliation mid-year to address defense, energy, and immigration, then they will have budget. Then second half, late this year and then early next year, you could see a stepped up pace of immigrations that result in a real constraint put on labor force growth at a time, and it's the internal inconsistencies in the Trump policy framework, right? They want to have greater than 3% growth, but to need that, you need close to 1% growth in the labor supply. They're going to be removing supply from the labor force, so they have to reconcile that. If you're an investor, that inconsistency can't go on for much longer.
And so, as an investor, if you are kind of looking through these revisions, looking at the new baseline, I say, that we've been talking about that has been set, what should you be kind of evaluating as you've had everything from DeepSeek rattle the markets earlier this week, all the way through to tariff activity be some of the larger considerations? Where do you kind of prioritize what could really play out over the coming weeks, months here, even as more policy decisions?
All right, well, for today in the report, I think it's favorable to risk assets.
Okay.
That's why you see yields going up, investors and traders are moving from bonds over into more risky assets and equities. Okay. We're going to get a pretty big tax cut, it looks like to me. It looks like we're going to have a pretty aggressive deregulatory agenda. It's very clear to me what that favors, right? Yeah. Finance, banks, private equity, private credit. What's going on in AI despite DeepSeek? I looked at the expected outlay on CapEx. Over the next 2 years, it's $750 billion. DeepSeek's not going to disturb that. Right. So you want to be thinking about AI data centers and AI energy infrastructure. I personally think, the feedback loop into energy is, well, how are we going to do this? Natural gas is going to get very favorable, right? I mean, that seems to me is not only it's the bridge for the next 50 years, but we're going to need that now to basically support the energy needs of the emerging AI industry. So this is all pretty favorable, if you ask me, towards risk assets, right?
Very interesting. Joe, it's always great to have you on set, especially on a day like today. Thanks so much. Before we head to break, let's do a quick check-in on the markets. Again, when you take a look at the futures action, we're actually now just above the flat line for the Dow and the S&P. You've got the Nasdaq right at the flat line, actually, as we speak. Flipping over to the bond market, taking a look at Treasury, we are seeing a bit of a move higher here in yields. You've got the 10-year yield at 4.47%. Again, this is on the back of that headline miss, but once you look underneath the surface, there's a lot to like in this report, as many of our guests have been telling us here this morning. Much more coming up on the other side. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you 3 things that you need to know this morning.
Good morning, everyone. Happy Friday. First up, U.S. stock futures little changed following the release of the January jobs report, which showed 143,000 jobs were added last month. That is below the average analyst estimate of 175,000, but unemployment came in lower than expected at 4%. Investors also keeping a close eye on the annual revisions. One standout is the December payrolls, which were revised higher to 307,000.
Plus, Amazon shares moving to the downside after the company issued disappointing earnings guidance and also warned that it could face capacity constraints in cloud computing. However, CEO Andy Jassy is spending big to retain the company's edge in cloud computing services, with the e-commerce giant announcing plans to spend $100 billion this year on investments.
And President Trump taking aim at a tax perk used by hedge funds, private equity, and venture capitalists, arguing it could be used to offset planned tax cuts. The president told Republican lawmakers that he wants to end the carried interest exemption, which allows them to pay a lower rate on their share of profits. Closing the carried interest loophole could reduce the deficit by $13 billion through 2034, according to the Congressional Budget Office, but private equity interests are expected to mount fierce opposition. U.S. stock futures little change this morning following the release of the January jobs report, which showed a bit of slowing in hiring last month here, at least less than expected. And as we got some of those revisions, the revisions to the upside, they certainly were noteworthy. And our guests have been commenting on what essentially was actually having some silver linings of a good print here after you consider what essentially has been added back into the household and established by the Establishment Household Survey as printed here for the January jobs report with some of the reconciliation that came forward from the BLS.
Yeah, I think when you take a look at this print, the headline miss was a bit of a surprise to the market. We saw that reaction initially play out, but once you look underneath the hood and underneath the surface there's a lot to like in this report, like Joe Buswarellis was just telling us here just a few moments ago. You have earnings coming in stronger than expected. The prior 2-month revisions, that's really one of the focuses here this morning. That puts the payroll level here for January actually higher than expected. And when you take a look at the revisions that we got for 2024, you're now looking at U.S. payrolls have an average monthly gain revised to 166,000. That was from 186,000. So not a massive change there, very much largely in line with what was expected. And I think you're seeing that very much play out within the market's reaction and really lack of some of those knee-jerk moves that we have seen on the heels of some of those prior prints. When you take a look at the futures right now you actually have all 3 of the major averages on track to open with gains. The Nasdaq just above that flat line. When you flip over to the bond market, you're looking at treasuries off the lows of the session. You have yields still pushing higher to the upside, though, although it's not a huge gain that we are seeing. When you take a look at the 10-year yield, just about 4 basis points to 448. So we are creeping actually a bit higher as the morning does progress, but again, still below that 4 or 5 level. So I guess the question is, what does all of this suggest? And it seems like from the guests that we have been talking about, from the numbers that we've been looking at here this morning, it doesn't really change anything right now for the Fed. If anything, it's likely to keep them on the sideline for a little bit longer. And then, of course, the question is, what is it going to take it to actually get another cut this year? And should the Fed potentially be cutting before the end of the year?
Yeah, the huge thing that this comes back to for me is where the wages have moved. And as we were breaking down the numbers earlier, one of the things that jumps out is actually a reminder of what Naylor Richardson had reminded us from ADP, saying, and of course, the context here is that if we do see wages continue to move higher, well, that's an input cost that businesses have to consider and how they're either going to absorb that or pass that on to the consumer. And essentially, that is a challenge for the Federal Reserve, because if labor costs are not going to go down and staying stuck at higher levels, that could translate into stickier inflation here. And then on a sector by sector basis, separate point, she also noted the manufacturing and construction declines here. You saw a little bit of that show up, but not a ton in this January jobs report. So a little bit of a divergence here, but construction and manufacturing, of course, not the biggest additives to this report and this overall headline print, but still, overall, they did move higher by single-digit thousands in this most recent January jobs report.
Let's continue the conversation around the jobs report. While jobs added came in just below the street's expectations, unemployment rate did unexpectedly tick lower to 4%, and wage growth coming in much higher than forecasted. We want to bring in Brian Jacobson. He's a chief economist and strategist at IXIC Wealth Management. Brian, it's good to have you. So was there anything, or is there something aside from the headline miss that's not to like within this report?
You know, it was a good report, and honestly, I didn't really know what to expect with it, mainly because we knew that we were going to be having some of those revisions. Also, there were possibly effects from the LA wildfires, also an incredibly cold period of time throughout much of the United States during that survey week. And so I really didn't know what to expect with it, so I was actually pleasantly surprised to see that it was within spitting distance of the estimate, especially considering the back month revisions, the November and December ones. So I guess, you know, kind of looking at that 3-month moving average, things are still looking pretty good. And in a way, I think this actually, I don't oftentimes like to compliment the Fed. I think most of us in the markets like to blame them for a lot of things. I think it actually shows that they made a pretty good decision to cut rates as aggressively as what they did, because when we look back, it actually did look like at that point that the labor market was beginning to stall. You know, we fell down towards 40,000 job gains per month right before they cut. So that made sense to cut. But now it's begun to come roaring back a little bit here. And so it kind of does make sense for them to now take a pause.
Yeah, Joe Brusuelas telling us a few minutes ago, it actually makes them look pretty brilliant, that 50 basis point cut that they implemented, and kind of shocked the markets here a little bit. But ultimately, as you think going forward, what this print means for the Fed's calculus from here, we're not anticipating a cut until the back half of this year, it seems like. And so what would they need to see show up in the data between now and then?
I think that the key thing that they're really focused on is inflation, even though in their recent policy statements, they have talked about the balance of risks between, you know, slower economic growth, or as far as with the job market, versus higher inflation. They say that the risks are pretty well balanced. I'm not quite sure that's true. I actually think that the risks are more towards inflation, and that is what they are really focused on. With an unemployment rate of 4%, they don't really have to worry too much about further weakening of the labor force. It's really more about the other side of their mandate with inflation. And there are enough anecdotal data points right now to point to suggest that businesses are actually trying to push prices higher in anticipation of possible tariffs. You know, when we looked at the ISM manufacturing survey, all the comments that were in there, some of them were talking about how businesses are already expecting that prices are going to be higher in the future, so they're pushing the prices higher now. So I think it actually does mean that the Fed is likely to stay on pause, probably until we at least get through the storms that could be in front of us for the balance of the winter and some of the spring.
Brian, when you take a look at these revisions, does it make you, is there anything to be, I guess, does that actually potentially even justify a rate cut at all this year? If we don't see, when you talk about the threat of inflation, I guess the better way to ask this, talk about the threat of inflation. What is the threshold that inflation needs to rise to in order for the Fed to act and get a little bit more concerned about the trajectory there?
Sure. So if we do get a one-off increase in the price level, and so let's just take as an example the threatened tariffs against Mexico and Canada. It's estimated that that could increase the price level by about 0.5 percentage point, maybe 0.7 percentage points. And that would show up as an immediate increase. So that would show up as inflation. As you move from one level to the next, that is inflation. But it is likely not to continue moving higher. Now, the Federal Reserve President, Austin Goolsbee from Chicago, I think he made a very good argument earlier this week when he talked about, you know, the companies that were able to reorient their supply chains out of China already probably have. And so whatever is still coming from there, it might be kind of stuck. And so that's the danger here, is that we don't just get this one-off increase in the price level, but maybe it actually is a little bit longer lasting, which would mean that the Fed would have to be on a much more pregnant pause with where they are with rates, or we have to see how things shake out. Maybe towards the end of the year, consider hiking.
Brian, if we can put your strategist hat on, what's the trade? Knowing in this kind of interim period, you could potentially be looking at a little bit more volatility while some of the policy decisions are rolled out, and thus the Fed also monitoring how that policy is ingested by the economy.
Sure. I think that one of my favorite areas right now, so here at IXIC on our investment committee, when we've been positioning portfolios, short-term investment grade and high yield, there's a bunch of ETFs, mutual funds, or if you can do it directly, that's an area that we like because really, if you think about if it's floating rate, that base rate, say the federal funds rate, might not be coming down that much. Spreads are very narrow, so you have to be careful about quality, but we think that it's still a strong economy, and those spreads are unlikely to widen materially. So short-term fixed income is an area that we really like, but then also consider large cap growth. There's a lot of negativity. Look at the response of the market to some of the quote unquote misses from some of the big tech players out there. You know, when Google has 30% cloud growth, but the market was expecting 31 or 32%, and all of a sudden they get punished a little bit for that. Yeah, people had high hopes for them, but the reality is they're still minting money. And so we actually do still like large cap growth mixed in with some of that short-term fixed income.
Brian, when it comes to that rotation trade, obviously it's something that investors are still calling for, strategists still want to see and are optimistic about seeing. But coupling that with some of the inflationary commentary that you're just getting, if we do see tariffs imposed, if we do see a move to the upside here on inflation, how much then is that going to push out any sort of broadening that we could see in the market?
Yeah, that is one of the challenges because during the first Trump administration, 2018 to 19, small cap value and small cap growth started doing really well at the first part of 2018, but then they began to lag. And part of that was because I think people realized that even though these are more domestically oriented companies, that they are still subject to the whims of the broader economic cycle, and they have maybe unobserved connections to global trade. And it was the bigger companies that were able to lobby and get exclusions and exemptions from some of those tariffs. So I think that maybe when you're thinking about where to position things, smaller cap companies, while I do love them, and there's a strong argument from a valuation perspective, they might have a tough time navigating any sort of tariff storm that we might be embarking on here.
Brian, thanks so much for taking the time here with us ahead of the opening bell and after this report. We appreciate it.
Thank you.
Amazon is planning to spend $100 billion in capital expenditures this year, driven by AI investments. Following Microsoft, which forecasts $80 billion in spending this year, Alphabet's $75 billion, and Meta's plans $65 billion. Shares of AMZ, and they are dipping this morning after its results. Our very own Dan Howley, he joins us now with more. Dan, Amazon saying it still can't keep up with AI demand. What do you make of this?
Yeah, Brad, this is kind of just part and parcel of what we've seen through earnings so far. The last big tech name that we're waiting for is NVIDIA, and they'll report later this month. And based on what we've heard from Microsoft, Google, Meta, and now Amazon, it could be a good quarter, well, should be a good quarter for NVIDIA with the amount of spending that these companies are going to launch into. So as you said, Amazon saying that they're going to have a annualized run rate of about $26 billion when it comes to CapEx. So that comes out to about $105 billion that they'll be spending. CEO Andy Jassy basically saying that the vast majority of that is going towards AI and AWS. They can't keep up with demand. They're capacity constrained at this point. The same song and dance we heard from Microsoft and from Google, basically saying, look, we would have seen better cloud growth. We probably would have exceeded or met at least expectations that Wall Street had on revenue, but we simply couldn't. We just don't have the means to do so at this point. And so when speaking on the earnings call last night, Amazon had basically said, look, it's a matter of trying to get chips from third parties and some in-between technologies that we need, and they just don't have those at the moment. And so this $105 billion roughly build out that they're going to have this year, which is up, by the way, from $75 billion last year, is hopefully what Amazon sees as the answer. And so, you know, as the prior guest was just saying, you know, Google did very well with their earnings as far as cloud revenue goes and growth goes. Microsoft continues to grow on the cloud side. Amazon continues to grow on the cloud side, despite being the largest cloud player out there. It's just when it comes to AI, they're just not able to keep up with demand. And so I think the bigger question goes to, okay, so we're seeing these kind of capabilities. When it comes to other companies like your Microsofts, like your Googles, like your Salesforces, when it comes to the applications, what are they seeing as far as business uses? So if there's all this demand, does that mean then for the technology itself, does that mean then that the applications are also taking off? So we have to see how that balances out in the quarters to come. But I mean, Amazon did do relatively well for the quarter. The issue I think that Wall Street took initially, because we didn't find out about guidance until the actual earnings call, was the shortfall on Q1 revenue. They're expected to come in between 151 billion and 155 billion for the current quarter, Q1. Analysts were looking for 158 billion. So obviously a big miss there. Basically, Amazon said in a statement that it's looking at about $2.5 billion in foreign exchange headwinds. And so that's kind of where that comes from. But, it was a good quarter for Amazon. The outlook not nearly what analysts have been hoping for. That spending is wild.
Yeah, certainly. And Dan, I think you hit the nail. It was so important to point out just the FX headwind there. And it looks like that's really the big driver here of this underwhelming outlook versus any sort of concerns about the fundamentals maybe of the business too. So reinforcing some of that bullish thesis right now on Amazon. All right, Dan, thanks so much. Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street, plus a tale of two earnings. We hone in on Pinterest as shares surge following its results. We're also going to break down the forecast from ELF as shares plunge as it cuts its outlook. All that and more coming up on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of today's session. with Yahoo Finance's trending tickers page. First up, we got to check in on PINS. Pinterest shares, they are higher by 20% after the social media app topped $1 billion in revenue for the first time ever during a stronger than expected fourth quarter. The company's revenue and profit forecasts for the current period also well above analyst estimates. CEO Bill Ruddy said in the earnings release, our strategy is paying off, and investors believe him this morning. Global monthly active users, they increased, those MAUs increased 11% year over year. 553 million people pinning their outfits or trying to figure out what they need to do to perfect their house or what the next DIY project is.
I'm a big user of it. I love it. I'm doing it right now as I redo my son's room. But anyway, when you take a look at some of the trends within Pinterest right now, there is a lot to like. And there is good reason that we are seeing such gains here ahead of the open, up just about 20% here. When you take a look at the outlook, the growth expectations, 15 to 17% growth here in the first quarter alone. When you take a look at the average user gains here on a monthly basis in the U.S., the fact that that is better than expected, also adding to that bullish thesis that we have seen here from Pinterest. And then just digging a little bit deeper, talking about the fact that some of the challenges here in the past, Benchmark actually upgrading the stock to a buy from hold. They have a new price target of $55 a share, which is about $15 higher than where we currently are. And in that note here this morning, they're saying that we have long been challenged by Pin's inconsistent engagement and monetization dynamics, but they now believe that these forces are now in sync, aided by some of those AI efficiencies. So again, when you take a look at the fact that this is maybe becoming more of an AI trade, there are signs as to where that productivity is benefiting and where that growth seems to be going, and the trajectory of that growth, which is boosting Pinterest by such a significant amount here this morning.
You ever come across a Pinterest board that just like really gets you going, that really excites you, gets you ready for either home shopping or, you know, I once found one and you really find out who your friends, who your family are, and how much they support your vision and your goals with their reaction to your Pinterest board. I once sent one to my dad. It was shipping container homes. I didn't know I was that interested in shipping container homes. And he said, this is it. This is it.
That's what you made a Pinterest board about?
I mean, hey.
I'm with him with that reaction then.
All right.
You know? That's an interesting one if you're going to do Pinterest.
38 minutes left in the show. It's all you. It's all you.
You get married one day. You could use it for your wedding.
Yes, true. Yeah.
All right, let's take a look at e.l.f. Beauty. e.l.f. Beauty plunging after the cosmetic maker cut its sales outlook for fiscal 2025, citing softer than expected trends in January. Several Wall Street firms, including UBS, Morgan Stanley, and D.A. Davidson, downgraded the stock after the disappointing forecast. Now, e.l.f.'s results coming in just days after beauty giant Estee Lauder announced plans to cut up to 7,000 jobs, blaming weak demand. So a very, very different macro picture that is going on right now at e.l.f. Beauty than what we were just talking about at Pinterest right now. When you take a look at what we are hearing, obviously a slightly reduced sales outlook for fiscal 2025, reflecting that softer than expected January demand that we have seen since the start of the year. You talk about the pipeline right now. You talk about the fact that consumers are pulling back on spending, all of that really setting up e.l.f. Beauty to be in a tough place at this moment. So again, you're looking at e.l.f. off just about 24%. We do have Estee Lauder up right now. They are posting slight gains here ahead of the trade, but that doesn't tell us much. I think much of that focus was on the results that we got out earlier this week when they did announce that massive restructuring and of course outline some of the challenges that are ahead for that company.
Yeah, what they talked about on the earnings call was particularly interesting, and they talked about some of the softness that you were mentioning to start the calendar 2025. They see three factors here that they boiled it down to. One, category continued to decline in January. They thought that decline was reflective of the consumer stocking up during, get this, a highly promotional period during the holiday, during December, plus also lower social conversation around beauty, and then also where the consumer mind share is right now as well. It's focused everywhere else, whether it be in the political sphere, whether it be on natural disasters, just that's kind of three of the elements that they were pointing back to. Uncertainty around TikTok platform even came up on this earnings call. So all of those things considered, they were pointing to some of those trends, the consumption being impacted to start 2025 here among consumers.
Yeah, and you have Morgan Stanley also downgrading the stock this morning to equal weight from overweight.
Finally here, let's talk a little Affirm here. Affirm shares, they're getting a boost after the company reported a surprise profit and better than expected revenue in its fiscal second quarter. Gross merchandise volume, the total dollar amount of all transactions on the platform, that jumped 35% to $10.1 billion, also topping analyst expectations here. Taking a look at shares of Affirm here, they are up pre-market by 12% to start off, well, not to start off the day, but ahead of today's trading activity. And this hopefully will offset some of the declines that they've seen coming into this print year to date. It seems like we will be set to take out all of the losses that we've seen year to date thus far as it had been down. But all these things considered, it's been a good past 52-week period, up 38%.
It certainly has been. And it's also been an environment where the bar keeps getting raised and they keep meeting and exceeding those expectations. So again, lots of questions about whether or not they were going to be able to do that this time around. When you take a look at that 12% growth here, their updated guidance, many are saying that it's still quite achievable. They are very encouraged about the trajectory right now that a firm is on. And when you take a look at their adjusted operating income coming in at 30%, that beat in fiscal second quarter, backed by 35% growth in volume, 47% in revenue. So really setting the firm up for a strong fiscal second half here going forward. And again, a lot of that strength being reflected in the move here this morning with shares up just about 12% ahead of the open.
Yeah, there's a lot of focus right now for this consumer trying to be able to leverage different payment opportunities, and even across experiences right now, it's seeming to take on even more traction. We had the Game Time CEO. Yeah, it's the Friday before the Super Bowl, so I'm going to talk about it here. We had the Game Time CEO on, and he was talking about how some of their consumers, they're seeing an increase in the number of users on their platform that are looking for some of those buy now, pay later, or pay in installments options. And this certainly is a company that has pioneered and been one of the early out the gate innovators for buy now, pay later feature. What he specifically said was that the buy now, pay later feature is gaining traction. It's only about 5% of their users that use that option, but it still is increasing in total of the percentage people using that for experiences right now.
Yeah, certainly. Well, when it comes to a firm, the fundamentals look pretty strong. The guidance is strong, and we're seeing the stock pop here just ahead of the open. Keep right here on Yahoo Finance. Coming up next is the opening bell.
Big opening bell energy. You're taking a look at the NYSE, where Titan is ringing the opening bell, and at the Nasdaq, where good is ringing the opening bell. There you're taking a look at the best bell ringers that we've got here for you in the US of A today. Taking a look at the Dow Jones Industrial Average, we are flat, but to the downside on this Jobs Friday here. The Nasdaq Composite, we are fractionally higher right now by about 0.5%. It seems as we're continuing to see things calibrate on this Wi-Fi Interactive. The S&P 500, there you're seeing that calibrate. A flat, and it's going to be waffling, hyper waffling, and oscillating between gains and losses here today. The way that the colors work out today, if you're in the red, then you're a Chiefs fan. If you're in the green, then you're an Eagles fan. I don't make the rules. Let's take a look at the sector activity out the gate this morning. We've got 11 sectors loaded up on our Wi-Fi Interactive here for you. As you can see, consumer discretionary, solid Arrowhead Stadium energy there. We're seeing that down by about 0.7%. But out of the gate this morning, oh yeah, in the mind of the communication services right now, they are bleeding green with the Lincoln Financial Field, and this chart is trying to populate. Ultimately, it's up 0.8%. More gainers than laggards. We'll see if that means anything going into Sunday. Also taking a look at the Nasdaq 100 here. We've got a good mix, and let me put this on an equal view just so we can see where that split falls. All right, more gainers than decliners here, but the biggest of the decliners on a percentage basis here, you've got Amazon down by 2.7% here on the day. And all right, the charts are going to continue to try and populate here. Take two. It takes two to make a thing go right. Well, this button and click is not going right now, but take two is up by about 10%. With all of that attempt, let's toss things on over to Jared Blickery to see if he has more luck with the Interactive this morning.
Well, we're up for a game of whack-a-mole here. Let's see if I can go back to the major indices where we don't have a whole lot going on, at least if you're looking at the early totals. Looks like the S&P 500, the Nasdaq Composite, and also the Dow all in the green for the day, just slightly. I'm trying to get a 5-day up here and see where we stand for the week. And barring this, we're going to move on to the 10-year T-note yield. And the 10-year T-note yield is up about 5 or 6 basis points. You can see up to almost 4.5%. That's an important number. And you can see we're well off of these lows that we were testing only yesterday and the day before. So we'll have to see how this develops. But the crib notes here to the 10-year T-note yield is heading higher too quickly, as tends to spell trouble for risk markets. And we're also seeing the U.S. dollar index up just a little bit, not much to be concerned about there, and we'll circle back to Bitcoin if we have time in a minute. Wanted to linger here on our Nasdaq 100 screen. Amazon was the worst off in the group here. It's down about 2%. Tesla has now turned positive, but that was leading consumer discretionary to be the worst performer here early on. Meta also, look at this. Meta has been up 15 straight days. We'll see if we can get a 3-month chart. There we go. All of this action here just hitting record highs. 12. Today would be number 12 in a row if Meta can just continue this streak here. So that's pretty impressive. And we got to go over to futures land here. That's been really interesting to see. Copper has now advanced 5 days, and it is at, let me get this straight, a 4-month high. So this is a 3-month chart, definitely the highest that we've seen on this chart. I'll give you a 5-year so you can see some of the pandemic action, and we'll see if this loads. But we are not quite back to the highs that we've seen over the pandemic when we had that heavy inflation. But we definitely want to measure this and keep it on track, because this ties into China. It also anticipates China's strength, and that's something that we are seeing today. Don't have time for that. I do want to get to coffee, because coffee also hitting record highs. The ticker is KC=F. And we'll see if I can find it here. There we go. It's up 1.1%. And this has just been this is just an intraday chart. Let me show you the 2 years so you can see what's been happening recently. It has just shot higher. It is up 13 straight record highs in a row. So lots of record highs here in some very different groups. We were tracking Meta and also coffee, and then the strength in copper. But it all ties into this risk-on flavor that we've been tracking in the markets, Shauna.
All right, take your pick. Jared, thanks so much. It's time now for today's strategy session. Earnings season off strong, with EPS and sales beats coming in higher than the historical average, just according to data from Bespoke. So will strong earnings continue to power the bull market? Joining us now, we want to bring in Carol Schleif. She's BMO Private Wealth Chief Market Strategist. Carol, it's great to have you back here on Yahoo Finance. What do you think of earnings season so far? Is it enough to carry on this bull thesis?
We definitely think we're encouraged by some of the signs we're seeing, not only from earnings season, but also economically. It was a big data heavy week this week for a lot of things, and it's very indicative of a stabilizing economy. But earnings, the nice thing is you're seeing a broadening in who's carrying the flag, if you will, on that. And so it's been interesting. You've seen the big Mag 7 stocks recommit to AI spending, which investors may or may not like, but clearly those big companies feel it's important for their future prospects. But you're also seeing a lot of good results out of smaller and mid-cap companies and other industries, the other 493.
Yeah, it's almost like 2024 was the test case for some of those companies who were announcing how much they were going to spend. And 2025 is kind of hey, just deal with it. We're going to be spending, and ultimately we are anticipating a massive amount of return on this CapEx, on this investment back into some of the AI instruments or build out of what our customers are demanding. But what's the timeline that they should be graded on for that actually returning into and turning into, I should say, some of the margins that investors are expecting as well?
Yeah, I think the interesting thing is the investment thesis is really shifting somewhat, which is very natural as we're building out the infrastructure, the backbone of something. Emphasis in the beginning, and this happened back in the 90s when we started building out the internet, because you had a lot of infrastructure built to begin with. That's where the investment focus was. Then the investment focus went on to the use cases of it. And so we've seen some of that shift in here in the last couple of weeks, where the interest is more in who's using the AI, how are they deploying it. You mentioned Pinterest earlier in terms of their use of AI in there, and you're hearing use case after use case. And so investors are starting to shift, and I think psychologically they're saying, that's great, you want to spend like that, you go for it, but we're going to go value somebody else for how they're using artificial intelligence and how they're actually deploying it to make the business run smarter, to focus on the productivity of their personnel, and to really take it up a notch.
Carol, I'm curious just how you're looking at the jobs report out this morning. The headline number was a miss, but once you look under the hood, there is the revisions that came in stronger than expected. We can take a look at the prior two reporting periods. How big of a relief is this for the market?
I think the market's relieved that it wasn't a surprise one way or another. You did see some migration in that 10-year, which it basically just says, when you look at it, it's indicative of a solid employment market. It's in a lot better balance than it was a couple of years ago. You saw it in other jobs data earlier this week, the JOLTS data, where there's fewer quits. People are feeling like they need to hang on to what they have. There's a sense that the job market, especially for white collar workers, might be a little softer than the data show. But overall, the data shows an employment market that's in fine shape. It gives more ammunition for the Fed to just sit back and watch this thing play out, because there's a lot for them to model, a lot to consider, and they don't have to be in any big rush to cut further.
What's the portfolio strategy for investors who are going to be monitoring how long the Fed is just going to be sitting back and watching?
Well, I think a piece of it is for the first time in a very long period of time, you're getting paid to put some ballast. You're getting paid for the ballast in your portfolio, being short-term bonds and high-quality bonds. You don't have to stretch for yield. You don't have to stretch out the quality curve to get yield in your portfolio. And so that piece of Fed that's going to stay somewhat higher for a whole lot longer means that you can stay at that short end and not run the risk that significant cuts are going to deteriorate those yields. So there's that piece of it, but there's also the piece that a stable Federal Reserve and stable rates out there give businesses the ability to be able to plan, because they're not going up, they're not necessarily coming down, so they can just move ahead with plans. And there's a lot of optimism, I know, around the fringes in the business community, and we've seen that in a lot of the NFIB survey and things like that. There's optimism coming through about, maybe a lighter regulatory touch, more emphasis on M&A, and a stable environment. So it creates a microcosm or a macrocosm, if you will, that allows businesses to be able to move forward.
Carol Schleif of BMO Family Office, thanks so much for taking the time.
Thank you. Happy Friday.
All your markets action ahead. Stay tuned. You're watching Morning Brief. President Trump is looking to end a favorite tax loophole of private equity to help cover the costs of his tax cut extensions. Joining us now to explain carried interest exemption and President Trump's history with the loophole, we're joined by Washington correspondent Ben Werschkoll. Ben, you've been all over this one. What do we need to know?
Hey, Brad. Yeah, so this came out of a 5-hour meeting that President Trump had with Republican lawmakers yesterday at the White House, where they're really just trying to hash out their overall tax approach. And this carried interest deduction you mentioned is on the list here. This is obviously, as you mentioned, a kind of favorite of the hedge fund and private equity industry, as it allows investment managers to pay a capital gains rate, which is much lower than a regular wage rate for their compensation. So it's closely guarded in that world. In terms of the response to this, this was quickly hailed by Democrats, who actually have a bill in Capitol Hill that they were introducing just yesterday as well to get rid of this deduction as well, because that's been a focus for them. It's a bit more of an uphill climb for Republicans, and the private equity industry has also weighed in to say that the reforms that were done in the 2017 Tax Cuts and Jobs Act kind of found the right balance, is the way they're phrasing it, and that's what should be continued, not a sort of wholesale removal of this deduction. What we know is that in terms of Trump's history on this, it's worth noting, as you mentioned at the top, that Trump has promised this in the past. He talked about this on the 2016 campaign trail. He talked about a full deduction, and then in the sort of process of making that 2017 law, it came sort of smaller revisions as opposed to the wholesale repeal. It also fell short in the Biden years. It's worth noting as well. There was an attempt there by Democrats, and some moderate Democrats didn't want it to happen there, so it fell short there as well. House Speaker Mike Johnson was one of the attendees yesterday, and he says that there's going to be a kind of a wholesale Republican plan by this weekend. We'll see if they can make that deadline, and how much detail and whether this deduction remains in there through this weekend in what's going to be a kind of weeks and weeks of debate on taxes.
And I know you mentioned that he had talked about it and had been discussed, and something that was widely covered during the first administration. Although I don't believe we did hear much about it, if anything about it, right, on the campaign trail. It seems like this is a bit of a surprise then to the PE market. And I guess what are you hearing there, just in terms of the business leader response?
Yeah, it's very, there was sort of very quick response from the private equity, as I mentioned. Venture capital folks were also weighing in, because, as you mentioned, this really was a surprise. They listed 7 priorities of the Trump administration for taxes, and most of them we knew very much. No tax on tips. He's talked about that nonstop. Extending these 2017 tax cuts on income is right up there. So this really did sort of take the industry by surprise. You saw market action in it. Some private equity firms, fell right when that news came out. So I'd say the overall answer to your question is a surprise here, and then a question of kind of how real is this, which we should know pretty quickly in the next few days.
Ben, how tough is it going to be for him to get some of those Republican lawmakers on board with it?
I think that's going to be a big part of it. I think John Thune, in particular, is seen as a person who's very wary of this. He was involved during the Biden years in sort of working with Kyrsten Sinema, who was then the Arizona senator, who was the Democrat who was able to pull it out of there. So he's definitely going to have a lot of pushback. And the other thing is that the sense I get of the meeting yesterday, it was this 5-hour meeting that Trump was in and out of. It's not like this deduction was the central thing. He was laying out his whole things, and he has this long list. I don't even get the sense it's not that Trump walked into the meeting and said, this is the thing I want to do. He listed a bunch of things he wanted to do. They've listed 7. This is 6 of 7. So it's a lot of surprise, but a question of whether this is kind of going to stay on the list for long.
Ben, thank you. Appreciate it.
Talk to you.
Coming up, everyone, Americans betting big on Super Bowl 59, wagering on everything from Travis Kelce's receiving yards to Kendrick Lamar's first song during the halftime show. FanDuel CEO Amy Howe joins us next with more on the bets ahead of the game.
Stocks trading to the upside after the January jobs report. Joining us now to break it all down is Josh Schaefer. And Josh, you're just getting out of your writing hole. I know that you've been focused very much on the jobs report here over the last 60 minutes plus. But one of the things that I think people are asking themselves right now is what ultimately this all means for the Fed and whether or not a rate cut is even on the table for this year.
Yeah, I mean, coming into the report, it didn't feel like the kind of jobs report where we're hinging on what's going to happen in March solely based off this report, right? But it feels like it really took a March rate cut off the table. Unless something materially changes, it probably takes a May rate cut off the table. And you're starting to have this debate of, is the Fed going to cut at all in 2025? And it feels like, again, as we were talking about the other day, it puts a lot more pressure on just the inflation data. If your labor market is looking like this, you have wages going up, you have revisions to the last 2 months showing 100,000 more jobs were added in the last 2 months than was initially reported, and you have an unemployment rate falling to 4%, that's at its lowest level since May of 2024 in about 8 months, it just doesn't feel like the labor market is giving any signals that the Federal Reserve needs to cut interest rates more. So to me, spinning it forward puts a lot more pressure on the CPI data you're going to get next Wednesday, right? And are we going to see continued falling in inflation? That seems to be the only thing right now that would prompt a Fed rate cut.
So how might the Fed's tenor change between now and then? Because we've widely talked about the fact that the Fed in this interim period of time is probably just going to be waiting back to see how policy moves from DC also impact the economy and the broader kind of economic picture that they're evaluating.
Yeah, Brett, I mean, we'll get a little bit of a look at that at about 10:30, I believe Sean is going to be speaking to a Fed official. So we'll get a little bit more insight into how maybe their tenor is changing then, right? But also, I think the wait and see approach seems to be the correct approach here and the approach we're going to continue to see. We've talked about sort of the impact that tariffs could have to the inflation story, right? And the impact that the inflation story could have to the labor market, right? We were talking just the other day about we have this steady labor market. What could knock this labor market off? Perhaps maybe it's the inflation story. And if inflation were to come up higher or stay too sticky in the second half of 2025, maybe that's one of your key catalysts that also unravels the labor market a little bit right now. But Chair Powell 2 weeks ago described the labor market as broadly stable. I have not seen an economist reading this report this morning that would argue that this report shows anything other than a broadly stable labor market. So it seems like in terms of describing this labor market, it's not reaccelerating, right? 140,000 some odd jobs is not massive gains, right? But it's certainly stable and certainly feels strong and in solid footing at this moment.
Yeah, it certainly doesn't make you rethink some of the strength that we have seen in the jobs market. Josh, just going back to the tariff part of the equation.
Sure.
And I guess just in terms of the inflationary aspect there, and it'll be very interesting. We're going to be speaking with Austin Goolsbee coming up in the next hour, and I'm sure he'll have some thoughts on this. But when it comes to inflation, I think it's fair to say that very much, at least economist perspective, and even what we've heard from Fed officials, not so much dismissing some of those inflationary pressures that could be associated with tariffs, but not too worried about it right now. Very much still in a wait and see type of mode. I guess the question is, if we do see some of those blanket tariffs, universal tariffs, how much that then changes a conversation from just a one-off pricing pressure conversation to something that would then be more material, and then how much that then changes the calculus of the Fed down the line.
Think about how many unknowns you just laid out, right? That's sort of where we're at this point, is the overall uncertainty hasn't left the room. Yeah. We've now delayed this tariff conversation a month, but we're going to be having the conversation again in a month, right? What happens with the Mexico and Canada tariffs? We just delayed it. And so at some point, it feels like we just need a little bit more detail here to start having a conversation that isn't just a little bit of a shoulder shrug to some extent.
Josh, thanks so much for taking the time this morning. Appreciate it. We've got more jobs coverage later on in the morning with Chicago Fed President Austin Goolsbee right here at 10:30 a.m. Eastern Time. Americans are expected to legally bet nearly $1.4 billion on Super Bowl 59, according to the American Gaming Association. That's more than an 11% increase from last year, with sports betting now legal in 38 states and Washington, D.C. Joining us now, we've got Amy Howe, who is the FanDuel CEO. And we got to know, what engagement are you seeing on FanDuel ahead of the big game?
Yeah, I mean, listen, the Super Bowl is always the biggest sports betting day of the year, and this year will be no exception. Engagement has been, listen, all NFL seasons, the engagement has been through the roof because the product's been so great. We have over 600 different ways to bet a Super Bowl this year, which is just phenomenal. You know, handle's kind of pretty evenly distributed, slight edge towards the underdog, the Philadelphia Eagles. But where the real action is on the player props, right? 7 of our top 10 markets are player props. Saquon Barkley is the odds-on favorite for MVP. And of course, anytime touchdown scores are always very popular. You can get part of a $5 million jackpot if you select one of our anytime touchdown scores. So there's a lot to engage in this year.
Is it mainly just experience bettors? I mean, when you talk about the Super Bowl and the opportunity then to get some more of those casual fans involved, what are you expecting to see this year? And is it a material difference from prior years?
Yeah, I mean, Super Bowl is always so great because you have very experienced bettors who have been with us for many years, but you also have a casual bettor who just wants to, participate with their friends and get in on the action. This year, we actually have a new product, which is appealing to both a casual user and a more sophisticated user. It's called Your Way, and we're effectively giving control to the consumer. So you can customize, you can go in, and instead of, the book may predetermine Travis Kelce is going to receive 60 yards, you can say, well, I think he's going to have a blowout game and he's going to have 87 yards. And you can customize your bet and literally make your own bet. So we're seeing a lot of excitement around that. So we're excited to learn. It's live in all the markets that we compete in right now.
Amy, while we have you, I wonder what you're seeing across the states right now. It sounds like Ohio's governor is pushing to push the sports betting tax higher. It looks like Texas and their lawmakers are looking to legalize finally here. What is the work that you're doing with the states to bring FanDuel to more fans?
Yeah, I mean, there's 2 big parts of what we focus on, right? One is safely opening up new states. Right now, you've got about 50% of the U.S. can bet legally in sports betting. So you still have California, Texas, some of the big states that have to come online. And of course, iGaming, there's about 12 to 13% of the population. And so there's a lot of hard work to educate state lawmakers and legislators around that. Listen, I think the important point here is the benefits of legalizing. You get phenomenal tax revenue, right? There's still a $500 billion black market with $13 billion in tax revenue that is not actually making its way back into the system. So we've got a lot of hard work to do.
All right, Amy Howe, FanDuel CEO, thanks so much for taking the time. Big weekend. Who do you have in the game?
You know what? I'm a Buffalo Bills fan, so I think I'm going for the Eagles.
There we go. Music to our ears. You're talking to 2 Eagles fans, Philadelphia natives right here. All right, Amy, great stuff. Thanks so much. We'll be right back. Welcome to Catalyst. I'm Shauna Smith. 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour. First up, we break down the market action following the January jobs report and get a read on the health of the labor market. Plus, we'll discuss what this all means for the Fed and sit down for an exclusive interview with Chicago Fed President Austin Goolsbee. And they look at big tech spending as Amazon caps the week of earnings where 4 of the Mag 7 giants reported. What does it all mean for the AI trade? We discuss. Amazon topping estimates for the fourth quarter earnings and revenue, but it did issue disappointing guidance for the first quarter, and that's a big reason why you're looking at shares off nearly 3% so far in early trading. The tech giant expecting a hit from FX rates. Joining me now, we want to bring in John Blackledge. He is the TD Cowen's Managing Director and Senior Equity Research Analyst. It's great to have you here, John. Let's talk about some of the commentary that we got out from Jassy on the call last night. A lot of it was focused, or some of it was focused on the AI spending plans, what exactly that looks like. I think that eye-popping number, just over $100 billion, might have been a bit of a surprise here to the street. But I think also just in terms of their ability to keep up with AI demand. What was your big takeaway?
Yeah, so they did guide to 100 billion-ish in CapEx, and that would be up a little over $22 billion versus 24. And they said the vast majority would go to AWS and the AI infrastructure build out. And we were at 95 billion in total CapEx. Sell side consensus was 84 billion. So it was a bit above the sell side consensus. We were kind of there. I also felt investors were around 95 billion. So not, it was above, but not, and I think people were bracing for it with the Meta results and Alphabet results. And to your question on the capacity constraints, yeah, I mean, CEO Jassy said, listen, like, we think AWS revenue growth would have been better absent the capacity constraints. That was also consistent from, kind of from what we heard from Microsoft and Google. And he said, with the capacity that they're going to bring online, it should be alleviated by the back half of the year. So that should be good as we round through the year for AWS revenue growth. And then he also said, like, we are making these investments. And historically, when we've done this and accelerated spend, there's revenue opportunity on the other side of it. And he called out that the AWS generative AI revenue is running in kind of like the multi-billion-dollar range, growing triple digits.
So then is the stock reaction today a bit of an overreaction?
Yeah, I mean, it's been a good start to the year. And just around the edges, and then you even referenced it, CapEx was a little bit higher. So, investors' CapEx, sell-side CapEx goes up. 1Q guide, the revenue guide was a little bit light at the high end relative to sell-side consensus. And you mentioned the FX drag and the leap year drag. And then the operating income guide was also a touch light. But I mean, all in, it was a pretty solid quarter. 4Q beat on revenue and crushed on op income, and so all in fine. So it's a little down a couple percent today. Let investors regroup, and it should still be a really good year for Amazon shares.
John, where does Amazon sit in your coverage list? I believe you also cover Meta is one of the names that you cover, and I believe Alphabet. How are they positioned relative to those two?
Yes, yeah, we cover Amazon, Alphabet, Meta, Netflix. Amazon was our top pick going into 2025. And some of the reasons were, kind of strong AWS revenue growth. Second was continued margin expansion. And we actually, off of earnings last night, we raised our margin estimates and our operating income estimates. And then the third point, which we haven't really layered in before, and one of the parts of the thesis is that we have free cash flow growing over 50% in 2025. And we just talked about this massive, kind of increase in CapEx over the last couple of years. Despite that, we have CapEx over 50%, and that's due to the ramping margins that we've seen at the company, led by AWS, which posted a 40% margin ex a one-time item in 4Q. Their advertising business growing high teens, super high margin. And then the other thing, dynamic on the operating margins that's helping cash flow this year is the rest of the business. We've seen a ton of efficiencies that they've been working on.
All right, looks like we're having some connection issues there. We'll have to leave it there, but we thank John Blackwell for taking the time to join us here this morning. Again, Amazon results, our Amazon shares pushing to the downside here, off just about 3% right now, 3.7% on the heels of that weaker than expected outlook that's weighing on shares just a bit this morning. But Amazon rounding out a week of big tech earnings, reporting a strong holiday quarter, but disappointing investors with its outlook for the current quarter. The company also announcing plans to boost CapEx to just around $100 billion this year, largely due to AI investments. This coming after Google and Microsoft also announced plans to spend billions on AI. Joining me now, we want to bring in Tony Wong. He's T. Rowe Price Science and Technology Equity Strategy Portfolio Manager. So, Tony, we just got the analyst side of the read that we've heard from big tech so far. I'm curious, just from a portfolio manager perspective, did it live up to those expectations and put to rest some of those valuation concerns?
Hey, well, you look at Amazon and think more long term, there's a few things that are really going well for the company, and they're kind of happening at the same time. So one, retail margins and kind of that utilization of their infrastructure for e-commerce is getting better. So you see that kind of march up quarter over quarter. And especially if we get a healthier consumer, that flywheel of like same day, next day should be improving and expanding operating margins and EBIT. So I think that's one. Number two, like AWS continues to grow pretty well. That 19% at that scale is impressive. And especially we get more AI tailwinds and they get more capacity. That's the second good driver. And then the third, I would say, is ads. Like that's a really high margin, high growth business. So when you have like those three things kind of all working well, I think that this sets up well for the longer term. In addition, I think when you think about where Amazon is and their kind of business, it's pretty. It sets up a good industry dynamic where they can perhaps like achieve better synergies with AI and robotics. So I'm really looking forward to hearing more about their chip strategy, how they differentiate themselves versus other clouds, and then how they integrate robotics and kind of drive further efficiencies and pass that kind of cost saving to the consumer.
So it sounds like you think some of the valuations here for big tech are justified following these results.
I think you have to go, kind of stock by stock. Big tech has done pretty well over the last few months, and Amazon's been up a lot over the last quarter. So, I think that you're always going to have some price adjustments, but over the long term, I think you look at like the type of returns that Amazon can earn, and at this scale, like I definitely view it's set up well, especially if like large language models get easier to deploy. The tech proliferates. That's probably good for the cloud. In addition, like maybe you don't need to kind of own the frontier model in order to benefit from it. And especially a lot of the open source dynamics kind of help be a tailwind. And Amazon can really plug that in across their, kind of large ecosystem of businesses. So, to me, like when you think about what you need to win in AI, it's probably scale, compute, AI talent, large customer base, a lot of data. And, there's a lot of ways that Amazon's well positioned.
Tony, I'm curious how you've been looking at the commentary that we've been getting from big tech CEOs in regards to DeepSeek. And that was very much has been one of the focuses here or maybe of interest for so many investors and analysts here over the last week or so following the revelation and the headlines surrounding DeepSeek. And I think overall, they've been very positive. We heard Mark Zuckerberg talking about the fact that this almost reinforces some of their spending plans going forward. Microsoft CEO Satya Nadella has also been very complimentary of DeepSeek. I'm curious, how do you see that impacting not only big tech, but maybe does it open the door for more investment opportunity beyond the Mag 7 when it comes to tech?
Yeah, I think that's a great question. A lot to, we're still learning about a lot of this. But, the way I see is that, tech, the evolution of tech is always to drive down costs and increase adoption. And I think that definitely is good for the long term. A few months ago, everyone was debating is there ROI in AI? And, here with costs coming down dramatically, potentially in some ways, you can kind of say that is bullish now. I think that this will definitely help proliferation of the technology of LLMs. And, I think there is this like kind of, debate of like who benefits the most. And I do think that in some ways, this opens up other players that were maybe subscale or too small, or maybe the apps were just too expensive to develop, that this opens the door for more innovation. And as a result, like, you could see a new kind of crop of companies that kind of do well behind this. And you're also seeing like the app layer really kind of inflect here. I think you saw Palantir earnings recently, and that just shows like a really nice inflection at the app layer. App loving over the last 6 months as well. So as kind of AI gets easier, more ubiquitous, you could see then stuff outside of the Mag 7 do well as well.
How about the AI networking side of it? Are there some plays there when you take a look at Sienna, when you take a look at maybe Coherent, just in terms of the fact that they could then leverage off of this and the wider adoption?
Absolutely. So I mean, you think about like where we're going with frontier models, like you want to pretty much cluster as many of them as you can, these GPUs or custom silicon, and kind of the more you cluster them, the harder it gets though, because a lot of times you need higher quality interconnects for the model not to like stall or break down. And so, I think that the networking aspect of it is definitely where a bottleneck is in terms of delivering AI infrastructure. So, I think that those stocks I've seen have done well. They're probably well positioned, and we're going to need to see a lot more innovation at that layer.
All right, Tony, always great to get your insight. Thanks so much. Have a good weekend. Let's do a check on the markets here as we head to break. February preliminary Michigan consumer sentiment falling to 67.8. That was below expectations. You actually saw the broader market turn lower on the heels of this print here. So you're looking at all three of the major averages pointing to the downside. You've actually now have the Nasdaq off just about 0.7%. And when you do look at this number, the February prelim reading is actually the lowest level that we have seen in just about 7 months. Expectations index, that fell to 67.3 versus a reading of 69.3 last month, and was the lowest level that we have seen since November of 2023. So a bit of a deterioration there. That, of course, weighing on the broader market here this morning. Again, you have all three of the major averages now trading to the downside. We'll be right back. Time now for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of this session. It's all done Yahoo Finance's trending tickers page. Joining us now to discuss all of these and more is Yahoo Finance's Alexandra Canal. Ali, let's talk Tesla, because right now we can see it on the bottom of our screen here. China sales falling 11.5% on a year-over-year basis here in the month of January. The EV makers' sales in the country are falling pretty substantially, while a Chinese competitor, BYD sales, they surged just about 47% on a year-over-year basis. We're also getting some headlines just in terms of the pricing strategy moving forward and what that looks like here for Tesla. Tesla actually raising prices of Model X cars here in the U.S. by $5,000. And very much I bring this all up because it paints the picture right now for Tesla, just in terms of what they are doing to get a leg up in certain markets, how that strategy very much differs from what they're seeing here in the U.S. versus what they're seeing over in China, where they've actually had to lower prices to be competitive with BYD.
Yeah, I mean, in China, they've really struggled. And this is a story that we have consistently talked about with Tesla. They just can't seem to crack that local Chinese consumer. The key is probably innovation, more potential models. I wonder what's going to happen when they start to release some driverless technology, if that's going to be a boon for the Chinese consumer. They have cut costs, to your point. They've tried to incentivize these buyers and even introduced a new revamped Model Y in China specifically. But, you know, we have been consistently seeing these sales slow, and investors are going to see something else, especially since these competitors are right behind them with their own versions of very similar types of products. But yeah, the comparison to BYD, I think, was pretty stark to me, that you have that local competitor, 50% year-over-year rise in sales, and then Tesla down 12%. That's not good.
Certainly. All right, let's take a look at Cloudflare, because it's jumping after a stronger than expected fourth quarter. The company beat expectations on EPS and revenue during its most recent period. Now, several firms, including Needham, Citi, and RBC, raising their price target on the company following these strong results. You're looking at gains actually of just about 14% here in early trading. So when you take a look at the initial reaction that we're getting from the street, obviously very encouraged by some of the trends here, but the 2025 revenue forecast pretty much coming in line with expectations, $2.09 billion. Adjusted operating income slightly below, actually at $272 million. But again, that focus on the growth that we are expected to see going forward, adjusted operating income enough to offset maybe some of those minor concerns.
Yeah, a solid quarter. You can see it with the double-digit stock reaction. Analysts are bullish, and there's reason to believe that Trump 2.0, it's going to be beneficial for cybersecurity stocks. His first administration was, at the time in 2018, he signed off on the National Cyber Strategy that aimed to encourage government and private investment in infrastructure of the cybersecurity space, along with greater innovation. And then you have the overhanging tailwinds, I should say, in the background, which is AI, the potential for more M&A, less regulatory, more deal-making under Trump. That could spur some profits and valuations in the cybersecurity space at large. And digging through some analyst coverage, it seems like out of the space in general, Cloudflare stands out as number one for a lot of these analysts. So it seems like you have a good environment, you have solid results, and that's going to take you through to a positive year in 2025.
Yeah, record growth in their largest customers there, those that are spending more than $1 million per year on a Cloudflare, reaching 173. They also added 55 customers in 2024, more than half of those new additions coming from the fourth quarter alone. So showing some of that momentum that we saw towards the end of the year. And Bernstein actually calling it a very, very strong quarter here for the company, saying that they've really just very much encouraged by some of these results that they are getting here. Firing on all cylinders. That was a quote I was looking for from
Very
Bernstein.
bullish.
All right,
Can't get better than that.
Thanks so much. Let's take a look at Huntington Bank, because it's getting a price target raise this morning following the bank's investor day, where it touted its plans for profitability and growth. For more, I want to bring in Steve Steinauer. He's the CEO of Huntington Bank. Steve, it's great to see you. So certainly there was a lot to be encouraged about from your investor day, some of the announcements that were made, the growth trajectory there for Huntington Bank. I'm curious what that tells us just about the macro backdrop right now and how constructive it is as we head into the rest of the year.
Well, we think that the backdrop is quite constructive. We had a great year last year, a solid second half, and then a fabulous fourth quarter. Number one loan growth, number one deposit growth, record fee income for us in the fourth quarter. And we came into this year with a lot of momentum, pipelines, backlogs, if you will, that were near records. So we believe the economy is performing well. Obviously, the jobs report this morning reflects that. We saw that in holiday sales generally. And so with the administration in place and some of the appointments now coming through, we believe we were in for a very good year and potentially a very good couple of years.
Steve, what about on the heels of this jobs print this morning, the fact that it was another overall strong report? A lot to like within those numbers has, of course, reignited or restarted the conversation that maybe the Fed is not going to cut rates between now and the end of the year. Is that bad for your business? What does that ultimately mean for Huntington?
Look, I don't think there'll be a lot of impact either way. What we're talking about is a marginal change in the timing of rate cuts from maybe July to September. Largely, the expectation now is that rates are going to be about where they are today, plus or minus a little over the next year or so, and then a trend line that'll bring them down a bit. We're not going to see the rates that we saw, these record low rates during the pandemic. At least in my opinion, that's very, very unlikely. So businesses and consumers are getting used to rates at these levels, and they're adjusting in the case of businesses, they're adjusting their expense base and as well as revenue to accommodate it. Generally, I think companies had a pretty good year last year.
Steve, are you seeing any sign of consumer slowing?
Well, there are pockets, and there's a disproportional impact. A lower income American clearly has been hurt by food and other inflation, but by and large, there's a big swath of Americans that are performing quite well, and we expect that will continue. And certainly, this robust jobs report amplifies that expectation.
We talk about some of the growth opportunity that lies ahead. One of the key themes during the investor update yesterday, when you talk about some of those projections and that rapid growth, what does that mean just for your overall footprint? And I guess where are you identifying those opportunities and the ability to gain market share, especially against some of your larger competitors?
Sure. If you back up to like the Silicon Valley failure, a couple years ago, a number of regional banks and others pulled back. They went on what were called risk-weighted asset diets, a term that was new to the industry. We had very strong capital. Our liquidity was best in class, any bank 50 billion or more at the time. And we were confident in our credit, and we had earnings to support the growth. So we actually leaned in. We opened up operations in North and South Carolina, as well as Texas, and we added 8 specialty banking commercial verticals. So it's been a lot of investment, a lot of change, and a lot of growth as a consequence of that. And that posture generally, the cores performed very well, and then we have these new growth engines. So we're doing well here in the Midwest, particularly in the central Ohio area. Generally, but in terms of economic growth and expansion, you'll see continuing new announcements of companies moving in. Anduril was announced, I think it was 2.5 weeks ago. Great new defense sector investment of size. Under roof, when they're complete, there'll be 90 football fields of manufacturing for Anduril. So we have a number of positive announcements locally and throughout the Midwest. And then a number of our businesses are national in scale. We're the 5th or 6th largest bank equipment financer. We're the number 2 in terms of distribution finance. We're the largest SBA lender. We do a lot with auto. I think we're certainly top 10. I don't know exactly where we are at the moment in that context. So we have scaled national businesses that we operate as well. And we're getting growth from all of them.
Steve, when you take into account the new Trump administration, looser capital expected, a more friendly regulatory environment, what does that mean for your path forward? Is M&A potentially on the table as you continue to grow?
Well, we set our capital targets. We're consistent. We manage those capital targets irrespective. They're more conservative than what regulators look for, and we think that's a prudent way to run the company. The same with liquidity. So there's no real impact that we're expecting or were expecting under even the old regime at this stage. Now, in terms of the regulatory environment getting more constructive, I think that's good for the industry. It'll certainly be good for us. And I believe it's good for America because that means, we're at the center of commerce. We make things happen in the business community as well as support consumers. The regional banks, super regional banks like Huntington, are the prime source of small business lending. Now, we're the #1 SBA lender in the country, as an example. And so it's really helpful to us, but also to America broadly, to put us in a more front-footed posture, doing more business.
Steve Steinhauer, it's great to get some of your time. Thanks so much for taking the time to join me here this morning.
Thank you
CEO
very much.
of Huntington Bank. Thanks, Steve. Coming up, we're going to dive into what the January jobs report means for the Fed's path forward. Chicago Fed President Austin Goolsbee joins us on the other side. The January jobs report showing that the labor market remains resilient, with unemployment falling to 4% and wages rising more than expected. And we saw job growth was even stronger than previously reported to end 2024 with those latest revisions. Let's send it over to our very own Jennifer Schomburger, who's joined by Chicago Fed President Austin Goolsbee. Jen.
Thanks so much, Shauna. And thank you, Austin, for joining me today on Jobs Friday. It's great to see you.
Absolutely. It's great to see you.
Austin, I want to kick things off with your reaction to this morning's jobs report. What really stood out to me was that the unemployment rate dropped to 4%, even as we saw that non-farm payroll number cool on the top line. Meanwhile, wage growth surprised to the upside, and we had some major revisions revised upwards. So given all of this data that we got this morning, how are you viewing the state of the job market now? And do you think that employment can be sustained at these levels?
All of those are important questions. As you know, every time I come on here on Jobs Day, I say, let's not get too worked up over any one month. And that's especially true for January, because there are a whole bunch of revisions that take place in January for the previous year. Now, that said, I think this was a solid report. It was close to what was expected. The unemployment rate ticked down a little bit. Taking all the broad measures together, because we got some question marks on any one of them, taking them all together, to me, it really feels like it shows we're settling into something like full employment. And that's a better spot to be than the one we were at, let's say, 6 months ago, where unemployment was just creeping up, and we were trying to figure out, are we about to continue and move into something worse?
You said we're settling into full employment here. President Trump announced 25% tariffs on Canada and Mexico, only to pause those for 30 days. But we have seen 10% tariffs on China. implemented and remain in place, given the potential uncertainty for tariffs to come back on Canada and Mexico, for tariffs on China to be even ratcheted higher, and the fact that we already are seeing tariffs implemented on China, how do you think that impacts the outlook for the job market?
But adds a little uncertainty. As you know, the Chicago Fed is the 7th district. We're heart of the Midwest, and as I say, we're like the Saudi Arabia of auto production. So I was just in Detroit talking to major auto suppliers and some of the major auto companies. The issues of the potential for escalating trade war being a wrench thrown into the supply chain is very real. It's on their minds. I'm hopeful that we have more experience like what we saw this past week or so, that for all of the argument, it ends up not being a big impediment to actual trade. I think if you look underneath the surface of this uncertainty, that really the job market looks like stabilized at full employment. We have solid growth. We have very solid productivity growth. Wage growth is about consistent with 2% inflation. And as I view the new months coming in, we've been getting good news on inflation that it looks like the path to 2%. So if we don't have too much policy uncertainty about tariffs, about geopolitics and that sort of thing, I'm still pretty comfortable with the path that the economy's on.
A couple follow-ups there. One, we are seeing inflation expectations ratchet higher this morning. Does that impact how you view the path for inflation at all and what that means for rates?
It could, but let me just emphasize the inflation expectations measures that are moving are these consumer survey of inflation expectations, and they're just for the short run, just for this coming year. That's less influential on my thinking than the long run expectations, and I've highlighted the market-based measures as being what I look at. If you started to see those market-based measures of long-run inflation going up, I would put a lot of weight on that. But those have been anchored absolutely solidly at exactly the target. The market believes, and the long-run expectations are not changing, believe that we are going to get back to 2%.
Austin, you said in a speech this week that if we see inflation rising or progress stalls, it's going to be challenging for the Fed to try to discern whether it's coming from overheating or from tariffs, and that, quote, the distinction will be critical for deciding when or even if the Fed should act. So if inflation is indeed coming from tariffs, would the Fed not act?
Well, my argument was, if you just look within the, let's call it economic theory, in principle, if it's a one-time tariff that increases cost but doesn't keep going and there's no retaliation, that's a transitory inflation shock. And I use that word with a little hesitation. In a way, you're supposed to look through, as a central bank, something that's only a transitory shock. But the hard part, if we were to get big tariffs, the hard part is trying to figure out, well, which part of the inflation is transitory and which part is permanent that you should be paying attention to. As I say, what my hope is that we don't see a rebound of inflation. But if we're going to add this policy uncertainty and we do start seeing a rebound of inflation, that's going to be a much more difficult situation, a foggier, dustier kind of environment. It's going to be hard to see the through line.
Do you worry that the 10% tariff on China is going to increase supply chain costs? And what are you forecasting in terms of the overall impact on inflation? You spoke to that in your speech this week.
I have some worries. But that's a job as central banker. If you say, what keeps you up at night? You're not supposed to sleep at night. You're supposed to be up running through every scenario that could happen. We still have to see what goods these tariffs would apply to, how long they would last. Is it just going to be on China? Is it just going to be 10%? We do have the experience of 2018, in which tariffs on China did not have a very big material impact on overall inflation. So it could be similar. It could follow a similar pattern if we just stayed where we were. But that's the one where, as I say, you brought up this speech I gave. In that speech, I said the only thing we can do is just get out there as data dogs and pursue the industry expertise, talk to the people in these businesses, and use our industrial expertise from within the Fed to try to figure out under the hood how big are the supply chain impacts going to be.
Uncertainty aside, it seems like you said we're at full employment here, the economy's in solid shape. You know, given all of that, where do you see the path for rates now? Does that mean that you may be on hold for some time?
Look, we may be on hold, but I see over the next 12 to 18 months, if we can get out of the uncertainty coming from policy or from geopolitics and commodities, I view the long run settling rate for the Fed funds rate to be a fair bit below where it is today. And if you look at the dot plot, there's pretty wide consensus that the neutral settling point for rates is down. I do think the speed at which rates would come down is going to be a little slower the more uncertainty and fogginess we add to the picture here. But overall, I still think we're on path to get back to 2% inflation. We've had a couple of months of pretty solid readings. In this 12-month trailing average on inflation is the only thing that's seemed to, in my mind, show that we've stalled out at too high a level. And that's mostly because of base effects, that in the first quarter of last year, we had a bump up in inflation. So if numbers keep coming in like the ones we've seen in recent months, that will start dropping pretty significantly as we go through the first quarter. So that's kind of where on inflation my eye is watching that.
Hey, Austin and Shauna, just jumping in here. So it sounds like there is still a very strong case then to cut rates again this year.
I have said over a 12 to 18 month period, my view of where is neutral is well below where we are now. In the summer, I said it was hundreds of basis points. We then cut 100 basis points, so that was a good way to start. And I said I thought it would be natural if there's disagreement, if we're trying to figure out what is the stopping point, that we might start slowing down, having some pauses, trying to feel our way to where is neutral. Because, as you know, monetary policy works with a lag, so you can't just precisely hit it and do it all in 1 month. But I still think that left to its fundamental devices, the natural settling point for rates is below where they are today, and we got to get there on a judicious timetable.
Austin, I'm curious just to get your thoughts on some of the commentary that we got from Treasury Secretary Scott Bessent earlier this week. And he very much said he's not worried about the Fed, or the Trump administration isn't focused on the Fed. They're more focused on lowering yields. And I bring this up in the context of how do you view market rates in context to policy, and what is necessary?
Yeah, I found myself in agreement with most everything that the Secretary of the Treasury was discussing. That he said they had an eye on trying to get long rates down, and the way they wanted to do that was upping the productivity growth, deregulation, trying to increase the growth rate of the United States on a sustainable basis. That it wasn't an argument with the Fed about what the short rates should be. As you know, the long rates, which are the most impactful on business investment decisions, on mortgages, on things like that, there are a lot of market factors that influence it. What are the expected long-run inflation? How much Treasury issuance is there going to be? What is it going to be, a shallow or a steep rate cut path on short rates going into the future? And then what's productivity growth? What's happening in the rest of the world? All of those factors are driving long rates. I don't think the Fed's mandate is about setting the Fed funds rate and the short rates based on maximizing employment, stabilizing prices. We take fiscal policy as an underlying condition in the economy, and conditions change all the time. So our job is to process, run through scenarios, process that information, and set the short rates. What's happening in long rates is in our forecasts and is in our evaluation of the conditions, but that's not our target. Our policy target is not to go move the long rates. It sounds like that's more Treasury's target.
Austin, how far are we, given what you just said, from neutral? And you said that you think that we're going to end the year with rates lower, assuming we don't have any major changes in policy that could affect the path forward. So given that, would we end the year at neutral, or is that something that's going to take more time?
I think it's going to take a little more time. Loosely, if you take the long run settling point out of the dot plots, there's disagreement over where it is, but it's still a fair bit below where we are today. And most of the dots suggest that this, if nothing else changed or what they would view would be appropriate, is that over 1 to 2 years, we're getting back to something like neutral. What's going to determine how fast we can do that is what happens to conditions. And I think we're on path back to 2% on the inflation side. And as that inflation comes down, we can commensurately be cutting the interest rate. That's where my starting point, where my head is. But as I say, there's uncertainty about what the truly neutral rate is. Monetary policy works with a lag. So we're going to slow down and kind of feel our way down to neutral. And I think that's perfectly appropriate. There's nothing wrong with that.
Austin, before I let you go, what are your thoughts on the proposition of a U.S. sovereign wealth fund, and would the Fed play a role in that?
I don't think the Fed would play a role in that. I mean, that's a fiscal policy decision. If we've ever heard of one, that's something to be decided by Congress and the president. As you know, the Fed's balance sheet, there are laws that restrict what we're allowed to invest in. And of course, our idea is always safety, safety, safety. You've seen the statement put out by the FOMC that we're trying to move the balance sheet to be all treasuries, not even MBS. And so I would not think that the Fed would naturally be an asset manager of the sovereign wealth style.
Austin, I want to thank you so much for all of your insight today. So appreciate you coming on Jobs Friday. Hope to talk to you soon.
Yeah, it's always fun seeing you.
Thanks so much. That's Austin Goolsbee, Chicago Fed President. Shauna, I'll send it back to you in New York.
All right, thanks, Jen. Coming up, we will be speaking with Newell Brands' CEO about the company and how it's navigating tariffs. Also out with the results here this morning, seeing a bit of a sell-off here in shares. More when we come back. Shares of Newell Brands are looking at losses of just about 27%, have been off about 29% in earlier trading. You're looking at the biggest drop that we've seen since 2008. This comes on the heels of the earnings results that we got from the company. Now, if you're not familiar, they're the maker of Sharpie, Rubbermaid, some other consumer-related products here. Now, the move lower coming on the heels of the guidance update that we're getting from the company. Disappointing annual outlook. Let's talk about this and more, especially as the threat of tariff looms. And for that, we want to bring in Chris Peterson. He is the CEO and president of Newell Brands. Chris, it's great to have you back here on Yahoo Finance. Your stock's been halted a couple times here this morning on the heels of the outlook, the preliminary outlook, looking to spook investors just a bit. Explain to us what's going on right now and the decline that we could potentially see here this year.
Yeah, frankly, we're a little bit surprised. It's good to be with you. But we just reported a fourth quarter that was very much in line or ahead of our guidance range for Q4. We provided initial guidance for 2025, and our initial guidance includes core sales growth improving in 25 versus 24, strong operating margin improvement, good cash flow, and strengthening of the balance sheet. We think we're making progress on the turnaround. We think that the priorities that we've established, we're continuing to do well with. And our guidance range for 25 was fairly close to what the street was expecting from a consensus estimate standpoint.
Does this factor in? I don't believe it does. Does it factor in the impact of tariffs?
It does not factor in the impact of tariffs.
So,
That's
Chris,
correct.
what does that look like then potentially?
Yeah. So on the impact of tariffs, what we said was that there's some things where we think we've got significant opportunities as a result of tariffs, and there's some areas where we think there's some challenges. So let me start by saying that about half of our business we manufacture ourselves in our manufacturing footprint. The largest part of our U.S. business is manufactured in the United States. And we believe that if tariffs go into effect on those categories where we have U.S. manufacturing presence, we will be competitively advantaged. We are already starting to talk to retailers about shifting promotions, shifting shelf space to some of our U.S. Manufactured product categories, and we think that's a tailwind for us. At the same time, we have some business that we are sourcing from outside the U.S. where we have potential tariff headwinds. Particularly on China, we've been working over the last several years to reduce our exposure to China manufacturing. Several years ago, about 35% of our business was imported from China to the U.S. That, as of today, is down to about 15%. And we expect that 15% of imports from China to the U.S. to be at 10% by the end of this year. Likewise, from Mexico, we think imports from Mexico represent about 5% of our cost of goods sold base, but we think we've got optionality in our supply chain and through productivity and pricing initiatives to largely offset that impact. So we think we've got opportunity in some of our businesses for tailwinds and some of our businesses for headwinds. It's too hard to predict at this moment what the net of that is. And so relative to the guidance that we shared this morning, we said that we did not guess where U.S. trade policy was going to land. We provided guidance without assuming any positive or negative from tariffs.
What does that tell us then about the timing just in terms of getting back to that top line growth?
So what we've said is this year, our guidance for core sales growth is -2% to +1% for 2025. And we expect in the first half of the year to be down low single digits. We expect in the back half of 2025 for the company to return to core sales growth. Importantly, we've returned our most profitable segment, which is our learning and development segment, already to core sales growth during 2024. We've returned our international business in total, which is about 40% of our business, to core sales growth. And we expect those two businesses to continue. Our home and commercial segment, which is our second largest segment from a profit standpoint, we expect to return to core sales growth in the back half of this year. And then the outdoor and rec segment, which is our smallest segment, we expect to return to core sales growth in 2026.
All right, Chris Peterson, we always appreciate you taking the time. Thanks so much for joining us here, CEO of Newell Brands.
Thank you.
Keep right here on Yahoo Finance. Much more of your market action ahead. You're watching Catalysts. Amazon is planning to boost its capital expenditures to over $100 billion this year as it continues to spend big on AI. Now, Amazon's comments bringing the total amount of projected spend between four big tech names to over $300 billion for this current year. And this comes after DeepSeek rattled the market with its low-cost AI model, making some of those out there skeptical of big tech's sky-high AI spend. Joining us now, we want to bring in Faisal Haq. He is author of Transcend: Unlocking Humanity in the Age of AI. And Faisal, it's great to have you here.
Thanks for having me.
Set with me. So walk me through just your reaction to some of that big tech spend. I think very much that was the question about whether or not that was the right move. We had the commentary from CEOs doubling down, very positive about the developments of DeepSeek. What do you think?
Look, I mean, you have to look at the larger tech companies' business model, right? So the larger tech companies' business models are enterprise. It's not necessarily just consumer. When you look at tech like DeepSeek and the things that are coming out of the market, the enterprises are not going to adopt those kind of technology, and there's whole kind of sort of risk associated with it. So I'm not surprised at all that Amazon or Microsoft or any other big tech are spending more money to gear up their infrastructure and their models so that they can be utilized in a secure environment in enterprise setting.
Does it change the narrative surrounding U.S. as a leader within AI and maybe what that could potentially look like?
No, it doesn't. I mean, I think that, you know, there's also a lot of misinformation about what DeepSeek is and isn't, right? So when you look at AI, there's a couple of fundamental things that we all have to think about. One is that this technology is going to be very pervasive, right? So responsible innovation and responsible utilization is first and foremost, right? That's one. Second is that who's going to use it? Is it that consumer? Is it that enterprise? Because, you know, there's platform vendors, there's application vendor, and there's the businesses, right? So, and then the last, but not the least, is the consumer usage, right, of AI. So from that context, I think we are, when I'm saying we, the U.S. is way ahead of that kind of secure, commercialized utilization versus a new app that just got launched by a foreign country, which we should not be using anyway.
Yeah, well, exactly, and that's kind of what I want to bring up, and maybe to that point, the national security concerns, and the story that was in the Journal earlier this week, that there's a potential look into whether or not it should be allowed on government devices. How do you see that conversation playing out?
Look, I work for DoD as an advisor and a contractor with my partner CSEI. I wouldn't touch it because you've seen this ongoing conversation about TikTok and collection of data, mining our population. AI is even much more pervasive than a social media platform. So from my perspective, when I put my national security and geopolitical lens, I would not use it in any of my devices.
So it sounds like an even bigger national security threat than what TikTok is.
Absolutely, because it's a data mining, data collection. It's a whole much more involved, and it's much easier to manipulate population with AI than you would do with social media.
Well, Faisal Haq, we wish you had more time. Thank you so much for taking the time to join
Thanks for
me
having
this
me.
morning, and congratulations on the book, Transcend.
Thank you so much.
Wealth coming up next.
It's time for Yahoo Finance's Market Minute. Stocks lower after consumer sentiment data falls to its lowest level since November 2023. Amazon shares lower after issuing softer than expected guidance, saying it expects a, quote, unusually large unfavorable impact from foreign exchange rates. Company also announcing a massive $100 billion CapEx spend for 2025. And Pinterest shares, they're surging. It's after the company reported its first ever $1 billion quarter. Several analysts boosting their price targets on the stock. Jefferies citing artificial intelligence as the next catalyst for Pinterest. Elf Beauty shares tumbling. That's after cutting its net sales and profit forecasts. The company expects weak demand in the broad beauty category for the start of the year. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the January jobs report that came out this morning. We'll analyze which sectors have hired and what it means for job seekers out there. And upscaling the workforce will bring you the tips and tricks to gain new skills and build wealth. Plus, we break down some of the economics of the Super Bowl, from snack prices at home and at-home spending and viewership expectations there. You don't want to miss any of it. We've got it fully covered here for you. The U.S., though, added fewer jobs than expected in January, 143,000 jobs added. Meanwhile, unemployment ticked lower unexpectedly to 4%. That's a good thing. And wage growth higher to 4.1%. So let's just break this all down and synthesize it. What does it all mean for the job seekers out there? And for that, we've got Julia Pollack, who is the chief economist at ZipRecruiter. Julia, great to have you back on the program with us. Just want to get your read through from today's jobs print.
So the big takeaway is that the labor market tightened. Unemployment at 4% is good news for job seekers. It's usually the sort of magical threshold below which participation increases because employers are under pressure and they have to increase wages and improve benefits and improve working conditions.
And so among the sectors where we did see the most job gains versus those that actually retracted a little bit, is there anything from your seat that either is different from the data that you're seeing at ZipRecruiter or runs in line with it?
No, this report very much runs in line with what we're seeing, which is that job gains are very uneven. The key driver of job growth is the healthcare sector. Other sectors have shown very spotty growth. We now know after the revisions in this report that the tech sector has been losing jobs for over a year. Professional and business services, very weak. The production sector in a total snowy freeze, a meltdown. Nothing's happening there under the weight of very high interest rates. And so if you're struggling to find a job, it's not you. It's that we have a very strange, uneven labor market right now. And if you really want to get work, you may have to pivot and go into healthcare.
That's so interesting. And one of the things that's become known recently is these ghost jobs, as they've been called, listings with no intention of being filled. How are you kind of looking through where that could have larger impacts, more long-term perhaps, on the labor force participation?
So most jobs that are posted and that are highlighted on ZipRecruiter are real because employers are paying real money to advertise those jobs. That said, the word that we hear a lot right now from employers is uncertainty. They are being very cautious, very conservative. They're posting jobs and then they're pulling back and then they're interviewing 20 candidates and then they're thinking about it a little bit longer. So this is a cool market in which there aren't as many doors open to job seekers as is usually the case.
Are there risks right now to the job market, and where are you seeing that pop up? Because we've seen everything from corporations either pulling back on some of the positions that were open or saying, hey, we can't do and matriculate internships even. And so it sounds like for the lower end of the younger generation cohorts that are looking for that entry point, that things could be a little harder at this juncture.
Well, very much in a period called the Great Stay, where firing and hiring are both unusually low. So if you have a job that you love, you're in a great position. You can likely keep it. There's unprecedented job security for those with jobs. But if you're looking to make a switch, if you're unhappy in your job and you want a new one, or if you're a new graduate, this is a tough time. Employers are being very conservative and cautious, and they're not really taking a risk on newcomers.
What does the Great Stay and the implications there mean for job growth more broadly as it pertains to future employment situation prints?
So, that top line employment number, the overall number of payrolls has been growing at a pretty strong rate and fast enough for the unemployment rate to fall. The funny thing is that we seem to be at a different kind of equilibrium from what's normal in the US. Usually we have a very dynamic economy where lots of jobs are being created and lots of jobs are being destroyed at the same time. We almost have shifted to a European style equilibrium where no one's moving and everyone's staying put. And that may be good for some businesses. They have more predictable staffing. They're not being blindsided by people not showing up on Monday morning and saying, to-do, we've found a better job. That's good for them. It's reducing turnover costs. But maybe it's also sapping our innovation and dynamism a little bit too.
So what would your tips be for those who are looking for jobs, looking to get into a new role in this environment?
Well, there's some good news. So in all of the surveys of employers that have come out recently, including ours at ZipRecruiter, employers overwhelmingly expect to add more workers in the next 6 months than they did in the prior 6 months. And so some doors may be opening. If you're a very entrepreneurial job seeker, now may be the time to start finding those hiring managers and reaching out to them and pitching yourself. It's also a time to set up good job search habits. Make sure that you sign up for email alerts so that you know when an appropriate opportunity is posted and you apply for it right away. Being one of the first applicants really, really improves your chances.
Julia Pollack, great to see you. Thanks so much for joining us again.
Thanks, Brad.
Let's take a look at some of the market action 90 minutes into the trading day. Stocks lower to end the week following a mixed January jobs report. Joining me now, we've got James Reagan, who is the D.A. Davidson Director of Wealth Management Research. You're expecting a meaningful pullback. How can investors prepare for that?
Well, I think we expect some volatility just due to some of the overall fears that are out there on tariffs and how economic growth might progress throughout the year. So we're still constructive on the markets over the course of the year, though. So how we prepare for the expected volatility is just to remain diversified across the sectors. I would say one of the bright spots of the year so far, where the indexes have been higher, are that we're seeing a broadening of the equity participation. So even when the tech sector isn't really contributing, we're still seeing the S&P 500 higher. And we think you can find some opportunities in sectors that are beyond just the technology area. So we're focusing on looking at earnings are so important with high valuation. So sectors that are delivering good earnings and still have reasonable valuations based on the growth rates.
What would the red flags or the warning signs to that pullback, that meaningful pullback that you're talking about, look like?
Well, I think to us the big risk, and we don't see it forming now, but I mean what we'll be watching for this year is that we do have elevated valuations, especially on a PE basis in the U.S. market. So if we see some erosion in the earnings expectations going forward, where companies become more cautious, that double-digit, 13-14% growth expected this year could be meaningfully lower. That would be the big risk. So that's what we're kind of keeping an eye on as the year progresses. And frankly, it's that's not really materializing at the moment. Where the fourth quarter earnings season has been better than expected, and I think that's giving some more confidence as we look ahead at 2025.
Are there sectors right now that look like better safe haven plays or better even quality plays right now versus others?
Well, I mean, so as I said before, we are looking at the earnings, we're looking at the growth rate. The four sectors that look attractive to us on a PE relative to the growth rate are still technology, communication services, but then also financials and healthcare. So you get a little bit of balance there. The financials would be tied more to economic growth this year and where interest rates go, whereas healthcare may be a little more contrarian in here, good earnings expected and a reasonable valuation because it kind of lagged the market in 2024.
As we've been hearing from some of the big tech companies who have been the kind of bellwether more largely for not just the AI trade, but also how confident investors can be given the outlooks that if these companies feel comfortable spending, then perhaps that means the rest of the market will also see some of that permeation as well across the board. Is that playing out to the same extent that we expected coming into this earnings season? And what would you be watching for there?
Yeah, I think I mean I think that's an important point. If you just go back a couple weeks ago now, when we had the DeepSeek news out of China, there was a lot of fear, going into earnings of what the big cap tech companies would say about their capital spending. For the most part, those companies have all reported now. Capital spending has not only not been cut, but I would say it's been raised for 2025. So the capital spending picture to support the tech investment looks pretty good. Although when you look at the economic data for the fourth quarter, we saw business investment overall weaker than expected. So I think what we've seen is that some of the money that's going into AI is going away from other, enterprise spending out there. So the money's just kind of being reallocated. But there's still, there's big spending going on in the AI space and the data center. And, that I think we did definitely get some confirmation of that over the last 2 weeks as those large companies have reported earnings.
Coming into this week, we had 36% of S&P 500 companies that had reported earnings. And of course, now that we've gotten through the majority of the Mag 7 names, the larger question is, okay, what grade do we feel comfortable giving this earnings season, even well acknowledging that we still have perhaps the biggest bellwether in NVIDIA yet to hear from them at the end of February?
Right. So depending on the grade, that's a good way of looking at it. I would say that the earnings have been kind of a B or maybe a B plus so far. The results have been good. The guidance has been a little more tepid, perhaps. But I think I looked at the FactSet data this morning. I think the earnings estimate now for the blended estimate for who's reported plus what's still to come is close to 16%. And you have had 6 of the Mag 7 have reported already. And I was just looking at that. They've contributed about 6 points to that. So you still have 10% earnings growth away from the Mag 7. I guess you could call it the Mag 493. And so I would say that that's been a little bit better than expected. And so it ends 2024 on a high note for earnings. Very aggressive estimates for 2025 as earnings growth is estimated to accelerate from 2024. But I think it gives us a little more confidence that we can at least do double-digit percentage earnings growth in 25. And I think the market is becoming a little bit more comfortable with that after this week's batch of earnings.
James, thanks so much for taking the time here with us today. Really appreciate the insights.
Thanks, Brad. Have a good day.
You too. Time now for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Market Domination co-host Julie Hyman. First up here, Julie, we got to talk about the brand of the swoosh, formerly Blue Ribbon Sports many, many decades ago. Nike getting downgraded by Citi from buy to neutral. Analysts cited the ongoing headwinds for the athletic apparel company's long-awaited turnaround, including continuing sales pressure, margin headwinds, and the potential escalation of tariff talk between the U.S. and China. And taking a look at shares, they're down right now by about 2%. Citi woke up and chose violence this morning.
Yes, they did. And the shares are actually almost at a 5-year low going back to March of 2020. As you know, there has been a lot of enthusiasm and hope pinned on new CEO Elliott Hill. And Paul Lejuez and the team over at Citi saying, your hopes might be misplaced for now. That perhaps after meeting with management, they are not as encouraged about the turnaround, and that there still are a lot of obstacles in place for that turnaround. Among other things, they talk about competition from smaller brands like Hoka that are still coming up. They talk about basically there's inventory problems in the various channels, right? The company trying to rebuild its relationship still with department stores and other wholesale channels, even as they maintain their direct-to-consumer business as well. Yes, there's the tariff wild cards as well. So there's a lot to contend with.
Yeah, absolutely. I mean, it was really striking here, especially how they were calling out the reliance continually on Air Force One, on Dunks, Air Jordan ones as well here, which, of course, for a lot of people, they're looking for newness right now within the shoe category. That's something that we hear brought up often among the analysts. So that'll be interesting to see how the companies respond to that as well. Let's stay in the shoe category.
Let's do it.
Our next trending ticker, Skechers' annual sales and profit forecast, they fell short of expectations. The shoemaker warned of the impact of tariffs on the company's fourth quarter earnings call. Skechers CFO John Vandemore said that the recently announced incremental U.S. tariff on goods from China has impacted our visibility. The company's fourth quarter sales decline in China despite solid growth across the U.S. and Europe here for Skechers.
Yeah, what's interesting to me with Skechers is it's not just the potential for a tariff effect, it's the currency effect now. We've already seen a strengthening dollar, and so that has meant a currency hit to Skechers numbers. And it's one that Vandemore also said could be 15 to 20 cents for the full year. That's part of the reason that we are seeing that forecast that's disappointing. So even if the tariffs are not being implemented, they're having an effect on that dollar sentiment. So a very indirect effect then on Skechers numbers. So kind of interesting. He does talk about that uncertainty related to tariffs, certainly, but I thought the currency thing was really interesting as well. And it's something that a lot of the analysts were talking about. On the flip side, our friend Jay Soul over at UBS, he still likes the stock. He said in a note, a solid opportunity to buy a growth stock. That's the way that he framed it here. And he's looking at some of the numbers, trying to look through the currency effects, and says at base that they still like the company. They said, we believe underlying demand for the products remain robust, and that the company's sales, margin, and earnings will grow much faster than the market expects. So there is still a defender, even as the shares fall by 10%. That one just stood out to me, I guess, amidst many other analysts who are not terribly, happy about that.
A defender, among detractors that are out there and present in the market. You got to imagine that Skechers is just sitting there and saying, wait a minute, what gives? Everybody's going towards the chunky sole shoes now with Hoka. We originally had the chunky sole shoes out there, so we'll see. We'll see if they're able to kind of bounce back.
Do you have any Skechers?
No, I do not. No, I don't have too many chunky sole shoes either, so.
We are a chunky sole shoe. That's really hard to say. A chunky sole shoe household.
I practice in the mirror.
But my husband has many Hokas.
Yeah?
All about the Hokas.
Interesting. Okay.
Yeah.
All right, we got to do a roundup. We'll do a newsroom roundup. Julie, thanks so much.
Shoe survey.
Yes.
Chunky sole shoe survey.
That makes it even harder. Thanks so much. Coming up, the spring selling season just around the corner here. We've got the tips for home buyers looking to take advantage. That's next on Well. Mortgage rates ticking lower for a third straight week, but still holding near 7%, according to the most recent data from Freddie Mac. This, as new data from Redfin shows 17% of homeowners with mortgages have an interest rate of at least 6%, marking the highest share in nearly a decade. Joining me now, we've got Mike Aubrey, who is the Mike Aubrey Group Executive Vice President. Great to have you here with us, Mike. So how are you looking at mortgage rates right now?
You know, I think that the hangover that came after the rates that we saw during the pandemic in the 2.5% to 3% range that we have been seeing since then has started to evaporate a little bit. I think that buyers are starting to see that these rates aren't going away. And if they want to buy a house, they're probably going to have to succumb to what the market's offering right now.
And so with that in mind, how is that kind of impacting the calculus for new versus existing home, as new home buyers are also trying to figure out, okay, where are they going to get the best deal to perhaps even on the new home side offset some of their mortgage rate exposure?
You know, I think that one of the things that we saw during the pandemic, and certainly with the advent of remote work, is that there were places that got really, really big, like Austin, Houston, New Orleans, Tampa. And I think that those spaces right now, as we are starting to see a compression of remote work, are starting to drop in terms of their pricing. So I think that for people who can live there and want to buy there, I think that they're going to see better deals in terms of price points. But some of the stronger bastions in the United States, like New York, Washington, D.C., San Jose, Boston, they continue to appreciate. And I think they're going to continue to appreciate as we go throughout the year. The reality is that, I think the president has said that he would like to see mortgage rates go down. But I think that it has finally occurred to him that that's not going to happen by trying to put pressure on the Fed and changing the federal funds rate.
Yeah, 3% was what he wanted to get it back down to. That's what he campaigned on. And, as we think about the policies now that are going to have to be taken in front of Congress, puts to paper, are there any policies that would bring home prices down?
Well, and maybe I'm being optimistic here, but I think one of the things that might help bring prices down is if we can get rates down. There has been some discussion about creation of a sovereign wealth fund. Now, what that looks like, I don't know that anybody really knows what that looks like, but say that they created the sovereign wealth fund and they started to purchase things like 10-year treasuries, as an example, which there is a linear connection between where the yield on the 10-year treasury is and where mortgage rates are. The same is true that if they created a sovereign wealth fund and they started to buy, say, mortgage-backed securities out of that sovereign wealth fund, they also could create lower rates, which I think in turn would create a stronger housing market.
It's interesting. Okay, and so as you have home buyers who are trying to even go out this weekend perhaps, and they've got their list, they've checked it twice, they've looked through all the specs, where are you seeing that they're finding perhaps the best averages in mortgage rates too? Because this is an average that we were talking about in the 30 and the 15 year. Where are the hot spots where the averages or the mortgage rates might be below average, or even on the other side above average?
Listen, this is sort of a tough to swallow pill, but I think that looking at adjustable rate mortgages is not a bad place to look right now. Again, using an arm not to buy more house than you can afford, but rather to decrease your exposure to rates. I think that there are some good arms out there right now, specifically 7/1 arms that are non-jumbo money, that I think that you can get well below what market value is.
Mike, just lastly, while we have you here, what are your tips for those who are going out and home buying or home shopping this weekend?
So remember, about a third of houses that were bought last year were bought in cash. To that end, if you are not a cash buyer, then don't get pre-underwritten, but rather get pre-underwritten rather than getting pre-qualified. That means go to a lender, get documented, send everything in that you have so you have a better chance to compete with people who are cash. Remember, inventory remains low. Give yourself a good shot. Basically, hire yourself a broker that does a lot of business in the area so you have an opportunity to see houses that are in private placement that aren't yet on MLS. And the last thing that I would tell you is, this is a contact sport. I think that if you see something that you like, don't be tepid in your actions. Go for it.
Mike, thanks so much for taking the time. Really appreciate it.
Thank you, Brad.
Certainly. The U.S. labor market added 143,000 jobs in January, fewer than analysts were expecting. Several industries saw little change in employment from December. The construction sector added just 4,000 jobs during the month. Joining me now with a closer look, senior reporter Danny Romero. Hey, Danny.
Brad, could the construction hiring slowed down in January? Like you said, in the latest government data, the construction industry added 4,000 jobs in January. And if we compare that to December's level, where the construction sector added 13,000 jobs. Remember, the construction industry is divided into two sections. We have non-residential construction and residential construction jobs. Now, in the latest report, the residential construction sector actually lost 200 jobs in January, and that's because of the high interest rate environment and also the pullback in housing starts. And so some economists are expecting that there will continue to be a pullback in residential construction jobs in the next few quarters. But this could be a benefit for non-residential construction jobs. If we take a look, the average hourly wages for construction workers is up 4.1% on a yearly basis, and contractors are expecting to beef up their staffing levels in the first half of this year. So that's good news for some contract workers that are looking for jobs. Brad?
Danny, thanks so much. Really appreciate it. Coming up, don't let money destroy your relationship. We have an expert breaking down how to harmoniously combine finances. That's next on Wealth. Let's get a quick check of the markets here as we're taking a look at the major averages here at the top of our markets board. You've got the Dow Jones Industrial Average fractionally lower. We did see positive territory to start off today's session. There was some hyper waffling at play as the major averages were trying to decide how to digest this morning's monthly jobs report. You're seeing the Nasdaq down by 1% right now, and the S&P 500, that's lower by 0.6% at this juncture. Let's see a little further under the hood what's at play with some of the sector activity, and for that we'll load up the 11 S&P 500 sectors here on the board. As of right now, consumer discretionary, that is pulling up the caboose. It's down by about 1.3%. Energy, though, that's up 0.3%, so that's holding on to some gains here on the day, fractionally as it may be. We do have more laggards than gainers right now. Let's take a look at the Nasdaq 100 as well. Who needed that paper? Taking a look at the mega cap tech stocks right now, you're seeing some deep red for Amazon after its earnings report. They're going to be spending over $100 billion in CapEx towards some of their AI ambitions. Those shares are down by about 4%. Google, Alphabet, that's also down by about 3.25% as of right now. Well, getting back to the big story that we're tracking here on the day. Interest rates are expected to come down this year, even if it's slower than investors were hoping. And the Fed lowers rates. As they do that, savings rates, they shrink too. So if you're looking to lock in a good savings rate right now, CDs may be a good option. Joining me now is our very own Casey Bond. Casey, can you tell us what states have the highest CD rate right now?
Yeah, so our team did some digging to identify the best CD rates in each state from both banks and credit unions. We found that the highest rate available today is in Texas from the Abilene Teachers Federal Credit Union. They're offering a really impressive 7.5%. Other states that made our top 5 include California, Illinois, Ohio, and Iowa. And banks and credit unions in those states are offering rates about 5 to 6%. So really, really impressive.
And so how does someone choose the right CD for their financial goals?
Sure. Well, the interest rate is obviously very important, but it's definitely not the only thing you should consider. One of the unique things about a CD is that it helps you lock in a rate for a certain period of time. But in exchange for that fixed rate, you also have to agree to keep your money on deposit for the entire term. Otherwise, you face an early withdrawal penalty. So choosing a CD with a term length that fits your savings timeline is very important. You also want to look at minimum deposit requirements. Some banks might require a higher amount of money be deposited in order to open an account. And also consider what type of financial institution fits your banking needs. Credit unions are great, but you do have to qualify to join, whereas local banks are open to anybody in the area. And I also encourage savers to look at online banks who often have really good rates, low fees, and you can open the account from anywhere.
Casey, thanks so much for taking the time. Appreciate it.
Thank you.
According to a survey from Credit Karma, a third of Gen Z and millennials, a quarter of Gen Xers, and over 10% of baby boomers have ended a relationship over financial issues. And with Valentine's Day just a week away, we want to make sure your relationship doesn't fall into this category. Susan Hirschman, who's the Director of Wealth Management for Schwab Wealth Advisory, joins me now. Great to have you here. Help us save some relationships, Susan. You recommend 3 steps for every couple planning to combine finances, addressing your difference, assessing your current situation, and making a plan. Let's start with the differences. Why is it important to note those?
Yes, I love talking about this topic. So thank you for having me, because it is so important. It's the first thing you have to understand from the differences. It starts on the emotion. So who are you? What is your money persona? So questions I think people should ask each other are things like, what was the money vibe in your home growing up? Was it positive? Was it negative? And why? I say money. What does that word actually mean to you? Why? I say the word debt. What does that mean to you? Why? And then finally, do you feel confident? Do you feel competent when it comes to investing and finances? So first, we want to lay the foundation down and truly understand where are each of us coming from. So once we understand the emotional aspects behind it, then we can go and start talking about the different financial aspects. and try and understand what I own, what I owe, how I think about saving versus spending, and going from there.
So how do you assess your current financial situation?
Yeah, it's very easy. It's just saying, what do I owe? What do I own? What's coming in? What's going out? So really just think about a balance sheet. So what are your assets, less your liabilities, and your cash flow? What is coming in? What is going out? And then see how they mesh up with each other, and really look at the way you spend, because that will give you a lot of insight into how you should separate, if at all, if you're both working, your money.
You know, as we're thinking about these 3 tips, of course, making an effective plan is a massive portion of this. How do you make an effective plan that really builds upon the previous step that we were just talking about and then shifts into activation and execution mode?
Yeah, so the number one thing when you're developing a plan is really knowing what you want to accomplish. And I always say, it's so, especially when you're in your 20s, your 30s, you know, it's hard to figure out what you want when you're 70 years old. But what you're trying to save for is flexibility. And so think about, what is it that you want to accomplish in 2 years? What do I want to accomplish in 5 years? What do I want to accomplish 10 years and going forward? So for example, in 2 years, we want to pay off our debt. Okay, great. We'll put a plan together to do that. In 5 years, we want to purchase a home. All right, what do we need to do to accomplish that? We both want to retire at age 50. Okay, what do we need to do that? So it's really looking at what you have, what you want to accomplish, and then developing a plan to best accomplish that.
Okay, so this is going to be a conversation that might startle or rattle some couples, but we're going to ask it. How do you know if you need a prenup?
Yeah, and a prenup is, you know, for historically, prenups have been done when people come to a marriage with a family business or a large inheritance or a family home, things that they want to make sure that they keep separate. But now more and more people are looking at prenups as more from a positive side and saying, okay, this will give us structure and clarity as to how are we going to handle our finances. And it's the what if, right? And for women especially, I think it's so important, especially if you're going to step out of the workforce, right? Forbid to have kids. How are you going to be protected? And, you know, I always say prenups to me is like fire insurance, right? You buy fire insurance for your home, hoping you'll never have to use it. A prenup is almost the same thing. You put it there so you have structure, you have protection, you have clarity, but you hope it's never going to be used.
All right, a lot of us have been watching and have checked out The Golden Bachelor, The Golden Bachelorette before. What's your advice for people more seasoned, looking to combine their finances, and what questions should they be asking?
Yeah, so with season comes children, comes healthcare issues, comes closer to retirement. And so all those issues need to be discussed. So for example, children. So especially if there's differences in the spouse's wealth, if one spouse has a lot of wealth, another spouse doesn't have a lot of wealth, and they each have children, is it going to be equal? Is it going to be, are you going to support each of them? How are you going to support the children is question number one. Question number two is, how are you going to keep your finances? Is what's yours, mine. The third is, okay, if something were to happen to me from an incapacity standpoint, how are we going to pay for that? Do I have long-term care insurance? Am I protected through your assets? Do we want your assets to be at risk to pay for my long-term care? How would your kids feel about that? And then also, what happens if one of you die? What happens with those assets? So it's really important to have the conversation about what's today, how am I treating my kids? What's going to happen at incapacity? And what's going to happen at death?
Some important conversations. Susan, thanks so much for taking the time here with us today. Very valuable insights.
Thank you. Appreciate the time.
Coming up, I'm talking to the CEO of Path about helping workers grow their skills and his advice on being a Black American founder for future founders and entrepreneurs. That is next on Wealth. The U.S. economy added 143,000 jobs during the month of January. That's slightly fewer than expected. And while healthcare and retail added over 30,000 jobs in the month, professional and business services shed 11,000 total jobs. Christopher Gray, Path CEO, joins me now in studio to discuss his work helping upskill workers. And this isn't a very important conversation right now, especially as so many workers are trying to prepare for changes that are coming forward through advancements in technology right now. Where are you seeing workers really appreciate the ability to upskill and take advantage of these opportunities too?
Yeah, so what we're seeing with AI being on the rise, cybersecurity is on the rise in tandem, right? People, legacy companies are afraid that AI is going to go crazy, it's going to be this Terminator situation. So, they're seeing a lot of careers in cybersecurity, AI certifications with AWS, Azure, CompTIA has been something that has been really prominent, because what the world is trying to do is really find ways to really get more people upskilled. And then with this kind of debate on the value of college and being fast tracking that, people are moving more to trying to get more certified quicker at a much less cost.
Which industries or even kind of job functions or role types are you seeing the largest opportunities for employers to make sure that their workforce is getting upskilled, and then also for employees to recognize that, hey, this is a position that could be at risk of being disrupted by AI, and I need to be able to work in tandem with it, or be able to skill into a new area as well?
Yeah, I think that what you're seeing, that AI has new developments all the time, but what you're seeing that JDs are starting to change, where instead of where employers are actually putting their JDs requiring you to learn to know skills like Cursor, ChatGPT, different AI agents, right? For designers to know different tools that can create and use generative AI tools to create more content. So what you're seeing is that the JDs, the job descriptions are changing, where you're now starting to see one marketing person can maybe do the role of 4 with using certain tools. So you're seeing is that companies are starting to maybe hire less people, and then there's also also this VC mandate where everyone's trying to get to this holy grail of how can you get to 30 million, 40 million in revenue with 15 employees or 20 employees with something that would agent. So I think that people will have the same jobs, but I think people will be able to be more productive. One role will be able to have the productivity of 4. Work will be, people will get more done with less. So I think that's what's happening. Like the JDs are changing and there's a requirement and prerequisite that you know skills. So I just recommend that people make sure they're learning these AI tools as a part of that and really convincing the employer, hey, you know what, by hiring me, I can actually help reduce your costs and be more productive rather than saying they need to change that job. Right?
And so where does Path fit within all of that?
Right. So Path, we're an AI-powered platform that uses AI to make getting professional certifications, particularly in IT, software engineering, and healthcare more affordable, right? We're seeing this movement where AI is being, it's taking people's jobs, but also to get a lot of professional certifications, like for example, CompTIA security costs hundreds of dollars to just take the test, right? And a lot of people don't pass on their first time. So what Path does is use a generative AI to give users unlimited practice, adapt to their weaknesses on these exams, but also use predictive scoring. So we can actually tell you whether you're gonna pass these exams or not. And we do the same thing for NCLEX. We even do college admissions exams like GMAT, MCAT, LSAT, GRE, even ACT. These things are causing, a lot of people affect their ability to get scholarships and ultimately have their ability to get jobs. And a lot of underserved communities, they're not passing these exams on the first try, right? And what happens is they're not getting into these jobs or they just shy away from the career. Like, oh, I don't have $800 just to mess up on that. So what we're really trying to do is rather than leveraging AI to focus on this concept of taking people's jobs, we're using generative AI to really help people get certified for the jobs of the future.
You know, we gotta give people some leadership lessons here because you yourself have been a successful entrepreneur multiple times over now, and most notably, people may know you from Scali, which went through the Shark Tank realm. You built up a business. You were probably one of the most successful, I would say, ventures that made it through that show, and then had an exit with Sally Mae as well. And now you're the CEO of Path. I wonder, what leadership lessons would you impart upon the next generation of aspiring entrepreneurs, business executives?
One, I think that in this age of AI, create apps that make a huge impact, right? I think AI has given being able to deploy a lot of products at scale for a much lower cost. So it's lowering the cost of it needs to start a company. I think the amount of money that I've had to use to start Path was infinitely less than what I'd used to start Scali because of the fact that so many AI tools have made marketing so much more expensive, developers are more expensive. It makes sometimes outsourcing even more efficient because these AI tools make the fidelity of the work of different engineers. And you see that with Google and other companies, right? So I think that really making sure that we're really creating solutions on the impact because I think so many people, we AI to book your travel, AI to get credit card points, AI to do this, but I really think, especially for underserved entrepreneurs and people of color really start creating products that really help. I think the second thing is that being adaptive and resilient. We have a new administration that a lot is going on, and it's things are changing. In addition to, we have this new technology that's advancing every single day, right? So I think that entrepreneurs being able to build a team that's keeping an eye on that, and being able to adapt and be resilient, and make sure that you're lowering your costs, being profitable, making sure that you're not overhiring for a role that you might even need tomorrow,
right?
And doing that. And then the last thing I would say is really just really expanding opportunity, right? Like thinking about working with your current team instead of being a founder and a leader and saying, okay, I'm gonna focus on how do I get rid of as many people as possible. One, you should make sure, don't hire people, really make sure you be thoughtful in terms of who you hire when you may not need them in a few months. But two, really make sure that instead of having those conversations with your team members and saying, hey, I love your role, you're a great team member. I think if you use these tools, I think if we adjust our role in this age of AI to do that, you can be more productive. Yeah. You have a long-term role here, and you can be a part of this team and be a part of this new era where, we can be more profitable, be more efficient, and still build a big company.
Chris, thanks so much for taking the time here in studio with us today. Really appreciate it. It's Chris Gray, CEO of Path.
Thank you.
Coming up, as we head into the weekend, we're breaking down the economics of the Super Bowl. We've got much more on wealth after the break. Stay tuned. The Super Bowl is just days away, and we're taking a look at what the economics tell us to expect when the Chiefs and the Eagles hit the field. Michael Swanson, Wells Fargo Agri-Food Institute's chief agricultural economist, joins me now. And you took a look at food prices and found that it is roughly flat from a year ago, but that doesn't tell the whole story. So what foods are more expensive than in 2024?
Well, yes, absolutely. The two big hitters right out of the gate are chicken wings and avocados. Those are fan favorites. And what we discovered was that the strong economy has pushed demand up faster on those two than supply can respond to it. So we're seeing a kind of a really bump from those two, but they're fan favorites. I don't think anybody can step away from them for this buffet.
And so what foods are, on the other side, less expensive than they were a year ago?
Well, we're seeing some of the competition, for example, around frozen pizzas, always a fan favorite, easy to put it in there. And then shrimp's down. Most of the shrimp in the United States comes from overseas, India, Vietnam, Thailand, some of those areas. And they're a little bit overstocked and they have to move it. And so shrimp's down. So maybe some ceviche, maybe some shrimp tacos. Those are always winners as well.
Wow, okay. How are GLP-1 drugs actually impacting how people snack while watching the game?
You know, that tidal wave is just starting. You know, we expect people to be healthier eaters as they start to take the GLP-1s. And good news for them. Some of the vegetables are down, broccoli, cauliflower, things like that. Put them on the tray. You might find some people snacking them more this year than last year.
And so there was record high viewership for the game last year. How do you think that will impact food spending as we're looking at what is a rematch, and if ticket prices for the get-in costs right now are any indicator, there could be maybe less viewers than last year, dare I say?
Well, you know, it's interesting. You never know about that till we get the final numbers.
Yeah.
But now it's received wisdom in the food industry that Super Bowls are now the number 2 largest spend for an event, right behind Thanksgiving. So we really see a lot of people really don't care too much about the final score, really appreciate the company and the food that's out there on the table.
No, that's a great point. It's the company you keep in a game like this. Okay, so, you know, as we're thinking about where these viewership trends have kind of moved year over year, is this expected to just continue to retain the title of the kind of chief gathering, sports gathering event? And how does that flow through to the food sales going forward in the future?
You know, it's a good question. You know, trees don't grow to the sky is the old saying, right? There's a limit to everything. And the NFL has been just a master class in getting attention, you know, social media and all that. But it can't keep growing the same way because pretty much have perfect penetration. So, I think that the food spending will kind of follow along with that. You know, it's the two kind of go hand in hand. So I would expect to see that food spending growth around the Super Bowl, kind of slower growth on a go-forward basis. It's been amazing, but you can't go to the sky.
All right, it's really interesting. We've been having a lot of food talk over the course of this week, and we will see both in stadium how much people are spending on food, and for a lot of those who are not in New Orleans, how we will be spending to entertain friends and family. Michael, thanks so much for taking the time.
Absolutely. Have a great week.
Certainly. Let's do a final check of the markets. Everyone taking a look at the major averages. We are lower across the board, fractionally down for the Dow and the S&P 500. The Nasdaq is lower by 1.25% roughly. As we're taking a look at these declines here, worth noting that we've got quite a few hours left on the clock here for today's trading session here. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They will count you down to and through the market close. Go Birds.
It's time for Yahoo Finance's Market Minute. Stocks lower following a spike in inflation expectations and a Reuters report that President Trump may announce reciprocal tariffs as early as today. Uber shares rising after billionaire hedge fund manager Bill Ackman wrote in a post on X that his firm now owns over 30 million shares of the company. Ackman, who is a day one investor in Uber, says that he began increasing his stake in early January at what he called a, quote, massive discount. Nike shares lower after Citi downgraded the stock to neutral from buy following a meeting with its new CEO, Elliott Hill. The analyst saying that uncertainty around tariffs could potentially weigh on sales and margins. And Alibaba shares higher after an executive said that reports that it plans to invest in DeepSeek are untrue. That's according to a Chinese media outlet, The Paper. Rumors swirled earlier today that Alibaba was set to take a $1 billion stake in the AI startup. And that's your Yahoo Finance Market Minute.